tratar como yo, no te va a besar como yo, no está tan rica así como yo. Ella es tímida y yo no con estas ganas que tengo yo. Me atrevo a comérmelo todo. Hoy estás jangueando con ella, pero después tal vez no. ¿Qué hubiera sido si antes te hubiera conocido? Seguramente estarías bailando hasta conmigo, no como amigos. Ey, ¿qué hubiera sido? Ay, si antes te hubiera conocido. Seguramente estarías bailando hasta conmigo, no como amigos. Ey, y yo te veo y no sé cómo actuar, bebé, pa' conquistarte que me pase en el manual. Espero lo que sea, yo no me voy a quitar. Tengo fe que esos ojitos un día me van a mirar. Yo me caso contigo, mi nombre suena bien con tu apellido. Estoy esperando el primer descuido pa' presentarte como mi marido. Yo me caso contigo, mi nombre suena bien con tu apellido. Estoy esperando el primer descuido pa' presentarte como mi marido. No has entendido que no te va a tratar como yo, no te va a besar como yo, no está tan rica así como yo. Ella es tímida y yo no con estas ganas que tengo yo. Me atrevo a comérmelo todo. Hoy estás jangueando con ella, pero después tal vez no. ¿Qué hubiera sido? Ey, ¿cómo? Seguramente estarías bailando hasta conmigo, no como amigos, no, no, no. Ey, 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 ey. Chiquita, chiquita, chiquita,
Big lift, old roads, we've been tearing up since way back when. But these wheels are innocent. New hitch, new seats, no hit story, and you just can't fake that. So let's change that, girl. Let's go put some miles on it. Back of the Chevy with the engine running. Just you and me in a truck bed wide like a California king. We could break it in if you know what I mean. Put some miles on it. Back of the Chevy with the engine running. Just you and me in a truck bed wide like a California king. We could break it in if you know what I mean. Put some miles on it. We could break it in if you know what I mean. All night, no breaks, I'll tell, no gate. Ain't gotta try too hard. My baby's push to start. I'll torque, full speed, off-road on me. 0 to 100 fast. My foot ain't touched the gas. I said, hey baby, slow it down, let's make it last. You said, where's the fun in that? Yeah, let's go put some miles on it. Back of the Chevy with the engine running. Just you and me in a truck bed wide like a California king. We could break it in if you know what I mean. Put some miles on it. We could break it in if you know what I mean. Put some miles on it. We could break it in if you know what I mean. Mile after mile
death, but maybe I should get some rest, 'cause I've been out here working all damn day. Blueberries and butterflies, the pretty things that greet my eyes when you call and I say I'm on my way. You and me belong together like cold iced tea and warm weather, where we lay out late underneath the pines and we still have fun when the sun won't shine. You and me belong together all the time. Spilling wine and homemade drinks, we throw a cheers, the worries sink. Damn it, it's so good to be alive. We know that we don't got much, but then again it's just enough to always find a way for a good time. You and me belong together like cold iced tea and warm weather, where we lay out late underneath the pines and we still have fun when the sun won't shine. You and me belong together. This love is all we need. Oh, we've got so much. You and me, oh, you and me belong together like cold iced tea and warm weather, where we lay out late underneath the pines and we still have fun when the sun won't shine. You and me belong together all the time. Goes on and on and on. Goes on and on and on. Goes on and on and on.
Please take your seats. The program will begin in 5 minutes. Please take your seats. The program will begin in 5 minutes.
I've always been your fool, but after all, we both know that it takes two. Tell me, was it such a crime when I took your hand in mine? You can call it destiny, don't blame it on me. Don't blame it on me. Can't blame the stars for shining. Can't blame the birds for flying. Can't blame a guy for trying. Sure I fell, but I had help. Take a look at yourself. Here I stand, falsely accused, but I'm just a man, and the mastermind was you. I'd take credit if I could, but I've never been that good. It just worked out beautifully, so don't blame it on me. Don't blame it on me. Everybody knows, can't blame the stars for shining. Can't blame the birds for flying. Can't blame a guy for trying. Sure I fell, but I had help. Take a look at yourself. Don't blame it on me for falling in love with you. Anybody could see there is nothing I could do. You just shot me that look, and baby, I was hooked. It just worked out beautifully, so don't blame it on me. Took it slow, played it smart. Thought that you would leave me with a broken heart. When you jumped, I followed you. I jumped without no parachute. After thunder rolls, all these wrongs, it worked out beautifully, so don't blame it on me. You can call it destiny, don't blame it on me. It was always meant to be, so don't blame it on me.
special place where boys and girls can all be queens every single day. I'm having wicked dreams of leaving Tennessee. If Santa Monica, I swear it's calling me. Won't make my mama proud, it's gonna cause a scene. She sees her baby girl, I know she's gonna scream. God, what have you done? You're a pink pony girl, and you dance at the club. Oh mama, I'm just having fun on the stage in my heels. It's where I belong, down at the Pink Pony Club. I'm gonna keep on dancing at the Pink Pony Club. I'm gonna keep on dancing down in West Hollywood. I'm gonna keep on dancing at the Pink Pony Club. Pink Pony Club. I'm up and dolls are on the floor. Lovers in the bathroom and a line outside the door. Black lights and a mirror disco ball. Every night's another reason why I left it all. I think my wicked dreams are here from Tennessee. Oh, Santa Monica, you've been too good to me. Won't make my mama proud, it's gonna cause a scene. She sees her baby girl, I know she's gonna scream. God, what have you done? You're a pink pony girl, and you dance at the club. Oh mama, I'm just having
Please take your seats. The program is about to begin. Please take your seats. The program is about to begin.
I'm gonna keep on dancing at the Pink Pony Club. Pink Pony Club. Don't think I've left you all behind. Still love you in Tennessee, you're always on my mind. And mama, every Saturday I can hear your southern drawl 1,000 miles away, saying, God, what have you done? You're a pink pony girl, and you dance at the club. Oh mama, I'm just having fun on the stage in my heels. It's where I belong, down at
Please welcome to the stage our host, Bloomberg's Derek Decluett.
Hi, everyone. I'm Derek Decluett from Bloomberg News. Thanks very much for rejoining us. Hope you had a great lunch. Welcome back. And we've got a really good lineup, jam-packed lineup of speakers for you this afternoon. Two really quick notes before we start. I encourage you all to please sign up for our new weekly Canadian finance newsletter. It's called Bay Street Edition with Christine Dobby. And you can sign up for it at bloomberg.com/newsletters. It's a very quick process. You just enter your email, and it's free. So please sign up for the Bay Street edition. Second, a reminder that you can scan the QR code right up there if you'd like to submit questions to any of the speakers. And I encourage you to do that. And now I am very pleased to welcome to the stage David Brulotte. He's the Delegate General of the Government of Quebec in New York.
Bonjour à tous, bon après-midi, good afternoon everyone. It's a pleasure for me to be here. Mon nom est David Brulotte. My name is David Brulotte. I'm Quebec's new Delegate General in New York. I was appointed 2 months ago. Very happy to be here, transferring from the West Coast, and I'm delighted to welcome you all this afternoon for an exciting session. First, I'd like to extend my heartfelt thanks to Bloomberg for putting together this amazing conference, National Bank of Canada as well. And Nick, our friend, thank you for having me this afternoon. It's a great honor for me to kick off the program after lunch. Let me start by saying maybe a few words about our presence here, Quebec's presence here in New York. We've been established here since 1940 and have a privilege of leading a beautiful team of 30 people that are active in developing our economic ties with the Northeast and obviously with New York. We also act as an intermediary in the financial markets, and today our office is really dedicated to enhancing our economic ties, government relations, cultural connections, as well as obviously promoting trade and investment. Speaking of our financial ties, for those who may not know this, they actually date back to 1879 when Quebec became the first foreign issuer of bonds here on Wall Street. Obviously today our partnership with the US is strong, continues to grow, with the United States being obviously our most important trading partner. Just to give you a couple examples, today half of Quebec's international trade is with the US, and as you've heard this morning from Consul General Clark, Canada is also the leading export destination for most of the states in the US. To give you a sense of perspective of what that really means and how strong our bond is, Quebec, the province of Quebec trades more with the state of New York than it does with France and Germany combined. And obviously, you know, the ties between Quebec and France are very strong. And Quebec trades more with the broader region of New York, Pennsylvania, New Jersey, and Connecticut than it does with China and Mexico combined also. So it's very significant. It really shows the importance of our partnership, of our supply chains, and much of this is trading goods between companies that together exports broadly. Another fun fact is almost 15%, I thought this was very telling about our close ties and relationship. Almost 15% of Canada's export to the US are actually exports by American subsidiaries in Canada, and obviously including in Quebec. And most of Canada's exports to the US are obviously through goods and services that are then exported from the US globally. So it really means that we're collaborating together to build strong jobs, strong connections, and strong, resilient supply chains. So it's one of the reasons I'm particularly excited to see so many of you today and to hear from several Canadian and Quebec companies and CEOs. This morning, you obviously heard from our Minister of Finance, Minister Girard, as well as La Caisse des Dépôts, the CDPQ, Quebec's pension fund manager, including my pension fund, so hopefully they do a good job. And as you all know, La Caisse is one of the world's largest, most diversified institutional investor. This afternoon, we'll hear in just a couple minutes, actually, from National Bank of Canada's CEO, one of the largest banks in the country, founded in Montreal. Very proud of this. Still an account holder at the National Bank of Canada. Thank you for this. My first mortgage was with you, so I appreciate this. And as you all know, the bank is very active here in the US and also internationally. We'll also hear from the CEO of Boralex, a Canadian Quebec-based company, making significant strides both at home in Europe and here in the US in wind, solar, and hydroelectricity projects, some of them here in the state of New York. In addition, we'll hear from other very famous Quebec companies that I'm proud of having here today, including CAE, TC Transcontinental, WSP, and GoEasy. Now, this afternoon's panel will obviously cover crucial topics, including how, for example, mining will be of great help in building clean and cleaner economies, and also the evolving real estate market in our jurisdictions. Now, business leaders often cite Quebec's and our province high environmental standards, clean electricity. For those who don't know, the grid in Quebec is 98% clean through hydropower and wind power. And business leader will also cite our integrated logistics chain, skilled workforce as key reason for choosing and investing in Quebec. But let me give you a couple examples of this. One of them that we heard about this morning is the long-standing partnership we have with New York through the Champlain Hudson Power Express, CHP, or what people refer as Chippy, which I found is much more telling. So Quebec has been supplying hydropower and clean electricity to New York for over 100 years, but starting in a few years' time, almost 1 million homes in New York, 20% of the region's demand will be covered and will be sustained and supplied by hydroelectricity from Quebec. This is through a 400-mile, fully buried cable coming from Quebec that will bring hydropower and clean electricity to the state. Now, let me conclude saying a couple of things. As we face new challenges, I think, as I mentioned, our integrated economies will be key moving forward. And our innovation and solution building that we'll be able to create will really pave the way for a greener, more sustainable, more prosperous North America. So on this, I look forward to hearing our afternoon speakers and panelists. Merci beaucoup. Thank you very much for having me.
Please welcome to the stage Laurent Ferreira, the President and CEO of the National Bank of Canada, for a conversation with Bloomberg's Caroline Gage.
Laurent, thank you for joining us.
My pleasure.
I wanted to start talking about the broader economic backdrop in which you operate. This morning, we heard from your chief economist, who described his outlook as a bit pessimistic in the short term. Is this something, a view that you share?
Yeah, well, we are in a slowdown, and we think, it's going to get a little bit worse in the short term. We have to keep an eye on an evolving labor market. September numbers were a little bit stronger on both sides of the border, but we think it will weaken over the next little while. I think there is still some economic pressure from monetary policy that is still restrictive. So rates are starting to come down, but that's going to take a bit of time. So we don't see before, short-term rates get to the area of around 3%. We think that it's going to, we're still going to see a bit of a slowdown in the economy. And
are you expecting rates to start dropping as soon as next week? Is that sort of the beginning of the next phase?
I think that's a very big possibility.
Okay. How do you see that rate outlook impacting the bank?
Well, the obvious headwind for financial institutions when short-term rates go down is the impact on deposits.
Yes.
And so that's, a bit of a headwind for all institutions, including us. Having said that, we don't base our strategy on where rates are going, and we've been through many rate cycles, economic cycles. So growing the bank and we have a very diversified business mix. So it's a bit of a headwind, but there are other businesses that, could do well. It could, help loan growth. It's always a good thing also for capital markets activity as well. And, shorter term rates will come down, but we believe, and I believe, that longer term rates will remain where they are, and potentially we'll see a steeper yield curve by the middle of next year, towards the end of next year. And that's typically good for banks.
So you brought up loan growth. I was hoping you could speak a bit about the state of the Canadian consumer's financial health and what you're seeing in terms of your credit exposure.
So absolutely. Higher rates impact more consumers in Canada because of the nature of the mortgage market. So they have been, because our mortgages renew every 5 years, impacted much more than U.S. consumers with mortgage payments. So we've seen a shift in behavior, definitely. But
how? Can you elaborate on that?
So discretionary spending is down significantly in a lot of areas. We're definitely seeing a lot more usage in unsecured credit. If I look at, which is small exposure for us, but if I look at our credit card portfolio from the low during the pandemic, because people were flush with liquidity, to today, it's up 30%. So people are using a lot more credit. But the structure of the market in Canada is such that there's general recourse to real estate for banks. So people are pay their mortgage, and so they adjust their behavior, their consumption accordingly. So I don't see, when we think about the mortgage market, I don't see any crisis looming in Canada because of the nature of the market.
Yeah, it seemed like there was a lot of angst about the extent to which stress with the consumer was going to flow through to the banks, and now Is there a little bit the feeling that that was perhaps overblown in terms of the impact across the financial landscape, or what do you think?
Well, I think we've demonstrated after this monetary cycle that the resiliency of the consumer is pretty strong. Delinquencies are up. There's, there are, depending on the product, depending on the region, depending on, the size of the payment shock. So we are starting to seeing a normalization of credit, which was totally abnormal during the pandemic. But nothing, I would say, better results than what was anticipated.
So delinquencies peaked then, and as we start to see rates come down?
I think we're still, we're in the middle of a credit cycle, and I think that we still have some ways to go. Have we reached peak? I think we're going to be hovering around higher levels and sort of levels that we have seen towards the end of this fiscal year in the industry in terms of provisions for credit loss. So I think those remain elevated for next year.
You brought up the mortgage market. Could you share what you see happening overall in housing going forward, and how is that going to impact?
There's an imbalance in Canada. We're not building houses fast enough. There's also an imbalance between we have condos and we need more rentals. So there are too many condos, not enough rental. And there's also an issue with affordability. So those things take a long time. They're not solved within a year. It's a generation, so 10 years for sure. So one of the things that we've done is focus our commercial real estate portfolio on multi-residential construction, and we've allocated a lot of capital and funding towards that. And I think that's what we should be doing is support as much as possible the build of residential.
What about in terms of prices? Unless I'm mistaken, I think we've started to see a little bit of more listings. I mean, why do you think, who's starting to sell, and do you see any of these sort of supply and demand imbalances?
Nothing out of the ordinary at this point in time. I think that we could see a pickup in activity towards the middle of next year.
Why?
We have rates coming down. We also have mortgage rules that have been changed, so we will allow 30-year amortization for new home buyers, and we could you can insure for our first home buyers up to $1.5 million in terms of a cost of a house. So those are things that are, I think, going to impact, but I think everyone is anticipating rates to come lower. So we're going to see, I think, a pickup towards the middle of next year.
Got it. Wanted to zoom in a little bit on the bank itself. Could you speak, I mean, what do you see driving growth over the next year? Which parts of your business?
Canada's our playground. So we're a Canadian bank, Canadian focused. Our core banking, PNC, wealth, it's focused on growing in Canada. We have a strong presence in Quebec.
Yes,
and
headquarters too, I believe.
We are headquartered as well in Montreal. And we see a lot of opportunity to grow outside of the province. I've been in place for 3 years, and we've put a lot of emphasis on growing outside of the province. And when we look at our loan growth, specifically in commercial banking, it's, depending on the quarter, sometimes 25 to 50% higher outside of the province of Quebec. Now, from a lower base, but it's still a beginning. So that's our focus. And the other part of our business is, when we look at outside of the country, we remain very targeted. So here in the U.S., we pick and choose where we want to be active in capital markets, where we think we can be relevant and make a difference. So renewable energy is one of them, where we have a very big focus here. We have the expertise, so we feel like we can be competitive. And so Canada's our market. When we get outside of Canada, let's make sure that it is accretive to returns and ROE.
We'll come back to that, maybe a lesson for some of your peers. But as you said, I mean, you are very much anchored in Quebec. I'm just wondering, how much have you benefited from the relative stability of Quebec's economy?
We have. The Quebec economy is in general less leveraged economy because of the house prices are much lower. You know, if I look at the one interesting data that I like to bring up, the variable rate mortgage product that we have, at the peak, the impact on the payment shock in Quebec was $600, so the delta. In Ontario, for our clients, it was $1,200. So less leverage, small, you know, house prices that are much lower, definitely has been a support, I would say, in general for our performance. You know, well-diversified economy in general, and I think more conservative, I would say, than rest of the country in general.
Mm-hmm. Now, I know you're excited about your CWB acquisition. I was hoping you could just share with us a little bit of an overview on why you see that being such a good thing, but also if you could give us an update on where we stand in that approval process.
So a couple of weeks ago, we got the approval from Competition Bureau. So within 4 months, very happy about that. We have to finalize our documentation for our regulator, which will be done in the next couple of weeks. And then it goes to Minister of Finance. And so we hope that everything is on the desk of Minister of Finance by the end of November. And close date early 2025. That's what we're working towards right now. Very excited about the transaction. Very excited.
Why?
Because it's a significant step forward for us in expansion outside of the province of Quebec and PNC. It's always been a bit of a struggle. It gives us a sudden foot on the ground. It multiplies by 6 our physical presence out west. It's exactly on target, on strategy. It's commercial banking that we understand, that we have an expertise in. And culturally, we are extremely aligned.
Well, that's a question I had for you, which is, I mean, you are talking about combining an institution that's very much anchored in Alberta with your Quebec. I mean, those are 2 distinct cultures. How are you thinking about integration there?
Well, we believe a lot in local leadership. We believe in the culture that we've been promoting, which is an entrepreneurial culture. And our past 2 years, we've been speaking together. And the most important thing for us was that connection. And National Bank was created by entrepreneurs, and CWE was created as well by entrepreneurs who had a hard time getting funding. And so there's at the base we're very similar. In the discussions that we were having over the past 2 years, we saw quickly that our values, the way we approach clients, the way we manage talent, the way we view growth was extremely similar. So that was very important. It was important for management. It was very important for the board of CWB. And it's an honor. It's an honor for us when the board of another institution says, we want to deal with you. We want to, we think that our future is with you. So that's, we spent a lot of time on that. Numbers you can make work.
People are more complicated.
Yeah, and I know you're going to bring up, well, the language is different, but we can communicate in English as well.
Like so, here, exactly.
Yes,
yeah. Well, I said I would come back to the question about the U.S. versus Canada. I mean, as you look forward, obviously you haven't yet closed this acquisition, but you're very much relying on Canada to drive the bank's growth. Many of your competitors have felt they needed to look south to the U.S. I mean, how do you feel about that? Will you ever be tempted to shift your focus a bit?
We won't change our strategy or our approach. So if there are businesses that we know we have the expertise, that we do really well in Canada, and we want to take part of the market here in the U.S., we'll do it. For instance, structured products in our capital markets business is a business that we've built the expertise for the past 25 years. And this year, we sold more products in the US than in Canada. So if there are businesses that we can export and that are accretive to returns, we'll do it.
Great. Well, thank you so much for your time. Pleasure to have you here.
My pleasure. Thank you.
Please welcome to the stage Tamara Lawson, Chief Financial Officer of Quad Real, Liz Murphy, Chief Financial Officer of Oxford Properties Group, and Teresa Netto, Chief Financial Officer of Granite REIT, for a conversation with Bloomberg's Ari Altstetter.
I want to welcome all our august chief financial officers to the stage. We're very lucky to have some senior people in such big and important Canadian real estate companies with us. So without further ado, I just want to jump right in, starting with a topic near and dear to Bloomberg's heart, deals, transactions. We love reporting on the buying and selling of real estate, and we've been wondering lately, everyone had said, when interest rate starts falling, that's when the market will kick up again. But we haven't really seen that yet. So I just want to sort of go around the horn here. I'll start with you, Tamara. What are we waiting for? Why have we not seen the flood of transactions?
Okay. I think, there's a lag between when interest rates fall and capital availability and then deployment. So, it takes a little bit of time to work its way through the system. The reason we haven't seen as many transactions in the last, call it year to 2 years is just there, as interest rates have increased, there just really hasn't been capital availability. And so, a lot of buyers, are maybe interested in acquiring, but they can't find the financing to do so. We recently sold. We're always buying and selling and recycling capital, and we were recently closed on a transaction that took us about a year and a half to close, which, in a normal market, it would be about 6 months. So the buyer had to arrange financing, and then, that took a lot more time than normal. So, I think that's one reason. There's another reason, I would say, in that, certain sectors are more attractive than others. So, there's sectors where people are sellers, and then other, sectors where people want to buy. So not completely aligned. And then I would say, as well, people are trying to keep their powder dry because they think there's going to be, distressed opportunities and good opportunities going forward. So they're trying to keep capital available for that as well.
Liz, I'll throw it to you. You hear a lot about bid-ask spreads still being too wide to get deals done. Now that there has been some movement on rates, is that starting to close?
Yeah, so I'll add to what Tamara was saying too. I think that it's not a massive rebound, but we are seeing a lot more activity in the market. Most recently, we've managed to sell retail, residential, and an office building. So there is some movement in the market, but just as was said, there's still a price gap but it seems to be narrowing. So I think some of the buyers, they're still being very hesitant. They want to make sure that they're putting their money in the right places. Also some capital constraints, it does take them a long time to find financing. We've seen the CMBS markets here in the US open up. The unsecured market in Canada is open, but direct lending market isn't quite there yet. And I think as the price gap is narrowing and cap rates, maybe they've peaked, maybe they've not. I think we're getting there. I do think you'll see more activity.
I just want to follow up, Liz, because some of the transactions that Oxford did, quite big, the office towers in Vancouver, this mall in Quebec City. Did that provide a sort of benchmark that you think will allow people use as a reference and start getting deals done?
Yeah, sometimes we get, sometimes the benchmarks aren't like that much, but I think absolutely, it's a benchmark. I think what it is showing is people are interested in trading. They're interested in buying real estate again. And to your point, with interest rates falling, we're sort of at a bit of an inflection point, and I'm hoping that 2025 is a big year.
One thing to just add to what Liz said too is on the capital raising side of things, like we've seen unsecured bond issuances go up a lot this year. Like it's over 30% increase, year over year in Canada and in the U.S. So that bodes well, I think, for transaction activity picking.
But that's not the full picture. Like as the public REIT on the stage here, I think it's been a frustrating 2.5 years, frankly, because with the rise in interest rates, I mean, the capitals, there's a huge capital outflow in the REIT sector, and, we've all been trading, well below our net asset values, and basically the equity markets have been closed for a better part of 2 years, which means, we really can't access the equity piece of the equation and therefore have, not transacted. Like our company itself, the last transaction we did was in the spring of 2022. And, yet, even though we've seen, 3 rate cuts in Canada, yes, we've seen a little bit of rebound in the REIT sector, but still not enough. For most REITs, we're still trading below our NAV, and it's just, we're just not going to be issuing equity at those levels. So we got to see a little bit more. Hopefully there will be 50 basis points coming next week. We'll see. But I think that'll help certainly with the REIT sector, get more inflows into the REIT sector, and then hopefully equity prices will be moving up and giving us the ability. Otherwise, you're having to recycle capital. And frankly, given some of the bid-ask spread that we've seen for the last 2 years, it just wasn't, we weren't going to do that.
So if you start looking for financing, are you more likely to go to the debt markets first or equity?
Well, I think, we're really concerned about our balance sheet. And I think in general, I think even, when you look at us relative, like Canada relative to the U.S., our leverage levels are much higher. And so the investors, I think, will only tolerate a certain amount of leverage when you're a public entity. And also, too, I mean, the banks and lending institutions, they were also pulling back on loan to values. So you're only able to borrow so much. Like for us, I think, we'll borrow, but we're not going to damage our balance sheet. We also need to, we want to control it and have a very conservative balance sheet. So we're just not going to borrow to transact.
So you'd like to wait for the equity market to come back.
We need a balance of equity and a little bit of debt.
Okay, I want to start with you, Teresa, for the next one, because I want to talk about industrial, and this is obviously an area that you're expert in, because during the pandemic, the industrial real estate market was the hottest thing on the planet, one of the hottest things on the planet. You couldn't own enough warehouses, there weren't enough warehouses for all the e-commerce we were doing, and that seems to have sort of turned overnight. And the industrial real estate sector is struggling now, and I'm curious why you think that happened and how long that weakness will persist.
Well, I think what happened is, you're right. So I think a lot of tenants, and so there would have been like distributors, manufacturers, the 3PLs in front of those types of businesses, they did lease a lot of space, and they were trying to get ahead of demand just because there was such high demand that they were just trying to get ahead of their business needs. But, I mean, with the higher interest rate environment, that did slow down the economy. I mean, despite the immigration growth that we understand so well in Canada, I think that they basically took on too much space. And at the same time, because we had seen such great fundamentals in the industrial space, i.e. cap rates were falling, market rents grew almost 150 to 200%, depending on the market. So it was a great time to build. And so we saw a lot of development, development that we hadn't seen in Canada for decades, frankly. So, you have availability rates moving to below 2% that are now reaching closer to 5%. And so there's been an influx of supply coming onto the market. Demand has slowed down. And so, and then we're starting to see now market rents fall. So we've seen market rents fall across all of the big markets, including Toronto. And you're seeing negative absorption because, again, that tenant demand is there. I think tenants, given the increase in market rents, they're also becoming more efficient with their space and use. And also they're also dealing with, trying to determine what economic circumstances are in the future and not willing to commit to a long-term lease at this point in time. So I think all of that, has happened in the last year and a half. I don't think we're seeing the worst of it yet. I think availability rates, we still have maybe, another 34 million, of supply coming in the next quarter. We'll probably continue to see negative absorption in all of our markets. I think we'll probably hit the worst of it maybe in Q1. That's my personal view. And then we might see a little bit of inflection, a change in point maybe in the second half of 2025. I think that's, as far as timing, that's kind of how we're seeing it. The good thing is, because of the interest rate environment that we've been in, new development starts have completely fallen off. So we've just got to work through the supply. And I personally think that's going to take at least another 6 to 9 months.
And so, sorry, just on Canada specifically, how long do you think before industrial rental rates, leasing rates start rising again?
I think that tension's going to in the second half of 25.
Okay.
Yeah.
And
I'll,
throw it to you guys.
I'll
sure.
just add to that too. Absolutely, industrial's been the golden child, and it's lost a bit of its shine. But I wouldn't say it's really struggling. No. I think what we're seeing is that tenants, cost of capital has gone up for tenants too. It's taking them a lot longer to actually make the decisions to lease. So we're hoping we're seeing some of that in the sort of, you're saying take some time for the absorption to wear off. And, but overall, I think the vacancy rate across Canada is just over 4%, which is still a very good place to be. And even when you look at all the building, I think in Toronto it's 2% of overall of all the builds, and across Canada 1.4%. So I completely agree with you. It's just going to take some time to wear off, and as interest rates go down, I think businesses will be more willing to make these decisions because and we'll see some movement.
I think the word, Ari, is it's not struggling. I think we're heading to a normalization. What we saw in 20 and 21, that's not normal, right? So we got to get back to a normalization, and I think that's where we're heading. But normalization means a gradual growth in rental rates, not 30-40%, a quarter. It's more like, we're going to see a steady maybe 3%.
That was probably unsustainable looking.
Yeah,
correct.
I would also characterize it as over exuberance that happened in 22 and 23, and things just got a little out of hand. We're still, we have a big portfolio of industrial in Canada, the US, and in Europe. We still believe in the long term. We think, the fundamentals will be sound in the long term. It's just a demand-supply imbalance that we're seeing in the short term. But even in our portfolio, we're still seeing on our portfolio increases in revenue because we were under market in terms of our lease. As Teresa mentioned, rates went up so high, and on our portfolio we're still below market. So we'll still see some benefit of that in our portfolio
as it rolls off into the new rents. Okay. We'll put industrial aside for a moment, and I want to turn to pension funds, because obviously pension funds are a big part of the investing landscape in Canada, and we're lucky to have senior figures of the real estate operations to the biggest pension funds. I've written a lot about pension funds and real estate this year, because there seems to be sort of a change going on in how Canadian pension funds relate to real estate and how much they want to own real estate and what they want to own. I'm wondering if you guys could speak to that and how the changing landscape in real estate is affecting how pension funds view it. So let's start with Tamara.
Okay. First of all, I guess first and foremost, I think most of the pension funds still have a conviction to the real estate sector and believe that it's part of the asset allocation mix that they want to see going forward. We haven't seen any change at this point in terms of that allocation. One of the things we are seeing is a little bit more of an allocation to real estate debt and a little less on the equity side, and also an ability to move between those two areas and keep the overall allocation the same, because debt has been performing very well in this year and last year, and expected to next year as well. So, but I think. So, I think there's a commitment to real estate. one of the things that we found, we've moved more to a direct approach. At one time, and the reason Quadrille was set up was really to be able to take advantage of direct investment. We've invested in operating platforms. We've developed operating platforms as well, and we think that's a way to outperform in the real estate sector, is to really be able to actively manage your real estate. We do a lot. We also do development, both domestically and through partners around the globe, where we think we can get outperformance by doing a lot of development. And you need a lot of boots on the ground. And I think now we're over 2,000 people, so it's a fairly intensive sector. And I think over the last number of decades, we've seen real estate perform well just because interest rates have fallen and cap rates have fallen. We think now we're in a different place, and it's really going to be about operating your assets and really asset managing. We believe strongly that we need a model that gives us that kind of operating flexibility and independence while still having the proper governance in place, and oversight in terms of strategy and also capital plans, but really allowing us to operate the real estate as we need to.
It's an interesting point you raised that I want to throw over to you, Liz, that for much of the history of the Canadian pension funds sort of famous foray into real estate, where they saw incredible success, became famous around the world for their direct real estate investing, it was an era of steadily falling interest rates. That era may be over. Interest rates may be they may at least stay elevated for the foreseeable future. How does that change the game for a pension fund real estate investor?
That's fair. I think on the first point, I think we've watched over time some of our peers, they have moved away from the direct investment model, and they've sort of moved to an investor, I guess, model, you would say. And I think what you're seeing, as Tamara said, I think people are keeping roughly the allocations to real estate the same. So I wouldn't say that interest rates are making them change. I think they're just changing in a lot of ways how they're managing the real estate and maybe adding more to credit. Even us, we've added more to real estate credit than we had before. So I don't think it's a sentiment that real estate is, interest rates have sort of hurt real estate permanently. I think, to be honest, teams are thinking like 2025 is a good vintage. We talked about sort of being at the top of the cap rates, so we're looking forward to them moving down, and I think everyone understands that real estate is cyclical, and we're at a tough time, but the next 5 years should be good.
Okay.
One thing I wanted to add, just made me think about it, is just also raising third-party capital. You kind of need this model like we've got, and like I think Oxford has as well. We have a joint venture with RBC where we're their asset manager for real estate, and having the model that we have with the oversight and governance that we have allows us to raise third-party capital and allows us to take advantage of opportunities. And work with other people.
It's a fee-generating business as well.
Yeah, it's a fee-generating business as well. And one of the things by creating Quadrille, we pay dividends to our shareholders, the pension funds, basically. So we've created a very valuable real estate asset manager that they own and they get the benefit of. So rather than paying, fees to third parties, it's creating a company that's valuable, and they're not, net because they get the income from us. They're paying a lot lower fees.
Interesting. I want to turn then. It's a point that's been raised a few times. Of 2025 is a good vintage for real estate. That there might be opportunities coming up. The idea of distress. We've been talking about it. It seems like nonstop the last 2 or 3 years. Any minute now there'd be this wave of distress. Dirt cheap assets coming available on the market. Teresa, what are your thoughts on that? Are we on the verge, capital dependent, if you can raise equity, are we on the verge of a buying opportunity?
You know what? I'm going to let the ladies speak to the office because obviously I wouldn't do it justice. But I think, like, certainly in the industrial space, we haven't, I think we thought we would see a lot more distress, and we just haven't seen it. We haven't seen it. In industrial space, we haven't seen it. I mean, the few transactions that we've seen in the last couple of years in Toronto, for example, assets are still selling over like $325 a square foot. I mean, it was maybe $350 during the pandemic. So we really haven't seen that much, price adjustment, interestingly enough. And we're still seeing private players, buy assets well below, cap rates, and, on the hope that they'll stabilize to some, level. They're buying it at 3%, thinking they're going to stabilize to like 5. And so willing to take on that negative leverage, for instance. So we haven't seen the distress. My personal view is anyone who's maybe been in a little bit of stress has been able to negotiate with their lenders. The banks have been very accommodating, and they're not willing to take back the keys, unlike you see a lot more of that obviously in the US because of the non-recourse lending environment here. But in Canada, the banks, they don't want to take over the assets. So they've been very accommodating, or there's been just private capital that's been able to step in if there's been a distressful situation. So I know for ourselves, we haven't seen the deals, and we haven't been able to really transact on anything that we would deem would be a good value. And so we've been kind of quiet on that front. So I think it's really been a unique environment, and not just in Canada, but I mean, in Canada is a little bit, I think, stronger relative to like other markets, like the US, as far as distress. We just haven't seen it.
Okay, so no deals in industrial.
Yeah, no deals.
Liz, where are we
You're going
looking
to turn
for
to me for office?
Yeah.
No, I think we also haven't really seen it either, because we really focus on Class A and trophy office space, and everyone knows there's a big bifurcation. And so we haven't seen huge price reductions in those two, Class A or trophy, to actually be interested in. And in some cases where we've seen, in a lot of cases, people have bought buildings in partnership, and we've seen in quite a few cases where if one partner's in distress, the other partner has sort of bought into the building or otherwise. So it's important to have the right partners at the right time, but we really, in the office side, haven't seen huge deals in what we're interested in Canada.
So if not office, where are there the opportunities that make 2025 a good vintage?
I would say I think cap rates have gone down. It's just not distressed, I guess. Sorry, the cap rates are at the right level, not gone down, but they're at the right level where we would be interested in buying in, but not at distressed sort of rates.
These are office assets, or what kind of assets?
Probably residential, office not as shiny a child as some of the other office classes, but certainly our investment teams, with the central banks sort of signaling rates going down, we were on our back foot, but now I think we're definitely on the front foot, sort of looking for the opportunities. But I would say more likely, everyone's looking at it now, but more likely on the residential side, because compared to our peers, we are underweight residential. So that's probably one area that we'd be interested in, and also maybe even some retail.
Interesting. Tamara?
Yeah, I mean, I think one of the things, we've seen a fair amount of capital raising in the fund sector. I mean, that's one of the reasons I don't think there's going to be the amount of distress that people were hoping for, because, there is liquidity and there is capital that's being, raised and ready to deploy. So, I don't think there will be the distress. There still could be some buying opportunities, but I don't think it'll be at distressed levels.
Okay. So, if Liz is seeing these not distressed, but buying opportunities in resi and retail is interesting, are you seeing something similar? Where are you looking for?
We're looking in, residential for sure, and we're still very committed to industrial, but we're looking in a lot of alternatives as well. Things like data centers, self-storage, cold storage, those types of things. Even areas like student housing is an area that we're committed to and continue to see opportunities. And then, one area that we're focused on is manufactured housing. We see, just with the issues around affordable housing, we see that as a sector that, we think is going to grow. We're a big owner of we own a large portfolio in Canada. We're looking at investing in similar portfolios in the U.S. We think it's a growing area. And it really has, it's a very fragmented business, and it has, a lot of mom and pop owners, and so we think there are opportunities there.
Okay, so as soon as rates fall low enough and maybe the equity valuations or REITs get back,
that's exactly.
The buying spree ensues. We have only 30 seconds, so I'll wrap it up there, and with a hearty thanks to all three of you. It's a great discussion as usual, and thanks to the audience as well.
Thank you.
Thank you.
Please welcome to the stage Marc Parent, President and CEO of CAE, for a conversation with Bloomberg's Derek DeCluet.
All right. Marc Parent is here. Welcome.
Thank you. Good to
to
be
our
here.
offices. This means we get to talk about airplanes, aviation, flight simulators, all the good fun stuff.
All my favorite subjects.
So CAE is really two businesses. You've got a civil aviation side and the defense and security side. And so maybe for the audience who aren't as familiar with the company, maybe you could kind of give an overview and also a bit of an outlook for growth for each of those.
Sure. Well, let me talk about that. I mean, not to correct you, but the way we see it is that we have one business. I mean, we train pilots. We sell simulators. We're number one in the world at selling simulators for the world's airlines. We train pilots both on the airline side, and business jet side, on the defense side. And those are really the two go-to-markets, what you were referring to businesses. We sell in civil, which is about 60%, give or take, of our revenue of our business. About 40% is defense. But in both cases, we're training pilots. We're training them in simulators. We train them in aircraft as well, especially on the defense sector. Headquarters Montreal, but we're at 40 locations around the world. Actually, 90% of what we do is exported. You kind of basically just talking about, in terms of our market position. I think the way I like to illustrate it is, and I'm very, very proud of that as a Canadian, is that anywhere you fly in the world, if you take an airline flight, and there's about, give or take 100,000 airline flights every single day around the world, very good chances that the pilots flying your aircraft have been trained in one of our simulators built in Montreal or one of our 70 training centers around the world. And when you think about defense, I'll just give you one data point. All 43,000 pilots in the U.S. military, all branches, are at some point in their career trained by CAE. So that just gives you a sense of the scale that we have in the world of pilot training.
Now we've seen it's been a really interesting and busy year in the sector. We've seen Boeing has had all manner of challenges. We've seen airlines in some cases pulling back, responding to different changes in consumer demand. In other cases, expanding. Maybe start by giving us your perspective on how you think about those challenges, and how does it impact your view, particularly of the civil side of the business, over the medium term?
Yeah, well, look, I think there's some temporary supply really challenges in the industry now, and really I see them as short term. You talked about it. I mean, Boeing has had their issues in terms of delivery of aircraft, but they're going to get over it. I know the CEO very well, and then they have good people at the helm, and they're a great company. They get through it, and they have a huge backlog. I mean, Boeing and Airbus have over 10-year backlogs of aircraft, and that's just fueled by the demand for passenger traffic. I mean, historically, civil aviation, people traveling in aircraft, airlines, basically revenue passenger kilometers, any metric you'll take, it grows by about typically 4 or 5% annually. That's been the growth rate for the last 20, 30 years, and it will be the growth rate years to come. And I think we have some catch up because typically it's in lockstep with GDP growth. And GDP has grown, substantially more since 2019 and the onset of the pandemic. And civil aviation has the ways to catch up to that trend line right now. And if you wonder where's that growth going to come from, I'll just give you just a couple of statistics. I mean, Boeing themselves, you talk about them, they predict that the number of civil airliners in the world will double in the next 20 years. And that means a lot of pilots. That means a lot of pilots. Just ourselves in our forecast for the industry of number of pilots are going to have to be created in the next 10 years just to support retirements and the rate of growth I just talked about. You're talking about 284,000 new pilots are going to have to be created. And half of those haven't even started their training today. And final statistic, you wonder where's that going to come from? It's going to come from the growth that I talked about, 4.5% on a global stage. But let me just give you just one statistic to illustrate the point. If you take India, for example, 1.3 billion people, there's about 50 wide-body aircraft in India today. In Singapore, not the same population, obviously, there's over 260 wide-body aircraft. So just think about that. So we're seeing across the world substantial growth, and in regions like India, in China, and the Far East in general, I mean, the middle class is growing. There's more availability of capital to be able to travel. The airlines themselves are lowering the cost of airfare, and there is no competing infrastructure. That's what's driving growth. So look, we have, going back to your original question, there's some temporary, what I firmly believe, temporary challenges to the supply of aircraft. It's not demand. If you go to airports, they're full. If you try to get on an airplane, they're full. We see it. The airlines that themselves, are basically scrambling to get the airplanes right now. But I think that's a temporary, issue on the market itself.
70 training centers around the world. What are the parts of the market or the regions of the world where you would like to have a bigger presence, and how do you plan to go about it?
Well, we are where our customers need us to be, and that's really around the world. And it depends on which market. In business aircraft, let's talk about our business. If I take civil, about the training we do, it's about half airline pilot training, about half business aircraft training. If you take that half of business aircraft training, a lot of it's in the United States. That's the biggest amount. That's the biggest amount of aircraft that there is out there for traveling in business aircraft. So you tend to have a lot of training centers in the United States, but followed very closely by Europe and places like Dubai, the Far East, in the Middle East. That's where the market is. In terms of airlines, well, airline is really global. And so basically you will find our training centers around the world pretty much in every major metropolis where you will have airplanes. You'll find a CA training center. Chances are, if you're at an airport, pretty much anywhere in the world, if you glance around, you'll probably see a CA sign, and that's a training center. Because training pilots you do it locally. If airlines, and I think it's very important to understand our business, to understand the fact that what we do is a recurring business. It's one of those, I think, probably the only job where every 6 months you have to go back into the simulator. I'm a pilot myself, and the first time that you fly in the real aircraft is with passengers in the back. Now think about that, reflect on that a second. All of your training is done on the simulator. All of my training, I mean, you're a pilot already, obviously, but all of the pilot training that I had to fly the jet that I fly was in the simulator. Consequently, first flight I had is literally with passengers in the back. Typically, the other person's not their first flight, but you get the point. And every 6 months, you have to go back into that simulator. So airlines around the world have got to have the infrastructure. They either have their own infrastructure of simulators to train your pilots, or, and which is a growing business for us, they'll outsource that training to us. Just like, you've outsourced any services in the industry. Think about IT outsourcing. I kind of make akin our business to that. Convincing airlines around the world to outsource their training to us, and we've been very successful at it. And we've really ourselves created the only global third-party alternative to conduct that training yourself. And so, ergo, we're customers need us to be, and that is around the world.
What's the acquisition pipeline look like in your industry? Are there things for you to buy?
Well, I'd start by saying that we don't need to acquire anything ourselves. Our growth plan is very much organic growth, and that's keeping lockstep with our customers. As I mentioned, if I think about simulator sales, we're number one in the world. We have a very high market share. We're essential to the world's airlines, and if you look at the driver of sales that way, it's essentially delivery of aircraft by Boeing and Airbus. Probably every 30 narrow-body aircraft requires a simulator in the market. And they tend to deliver about 60 aircraft a month, on either side of just narrow-body aircraft. Then you have wide-body aircraft. That gives you an idea of what we will get in terms of selling simulators out there in the market, and that is basically actually negative capital because we get advanced payments for the product that we sell. In the training business, again, it's a recurring business. As I mentioned, we have 300 odd simulators out there around the world in our 70 training centers, and we will add simulators, and that's the organic side of things, the CapEx, to grow with our customers. As they grow their fleet of aircraft, we will add to that capacity, and incrementally, and that's the other side of acquisitions, if there's an opportunity, consolidate, do a JV or something with an airline to, again, get them to outsource their training, we will do that. On the defense side, it tends to be organic itself, and in terms of JVs with original equipment manufacturers, like, I'll give you an example. I was in Sardinia 2 weeks ago. We have a joint venture there with Leonardo. Leonardo is considered like the Boeing of Italy, for example, Airbus of Italy. We have a joint venture there with them where we train fighter pilots for literally 13 nations out there. And we own fighter aircraft trainers. We have simulators. We have a whole training environment there. And actually, these pilots there, and that's really an organic play with some contribution of airplanes to support the growth of the operation. And there, we're training pilots. We had I was interviewing some pilots there from the Japanese Air Force. They're trained with us. I mean, if you look at these pilots, they're kids, really. They're going straight from our training directly into flying F-35s. And they're completing their training in January. And you think about the kind of missions that they'll be flying, and they're going to be flying combat air patrols around Japan, around Taiwan. So it brings home the essential nature of what we do, the essential training that we do.
Let's talk. How do you finance growth? Maybe a capital question here. As you embark on this journey of 5 or 10 years, getting much bigger. Mm-hmm. How do you intend to finance it? And any thought about the dividend that you suspended at the beginning of the pandemic and has not yet been reinstated?
Well, look, I start by saying our business is very cash generative. So, as I mentioned, our growth plan, we're going to grow with growth in our industry, and we'll grow beyond this because we have more opportunity either with market share gains in both of our markets, and again through potentially more joint ventures or more acquisitions of airlines. But we tend to be able to internally finance our growth, and that's our plan. In terms of the dividend, look, it's an ongoing conversation that we have with the board of directors. Our focus has been to deleverage, and we're still on that path. We deleveraged. We reached the deleveraging targets that we set in the past year. We'll continue to do so. So, look, I think that's a conversation that's going to continue to be active. We did some share buyback in the past period of time, and so that's really where we stand at the moment. At
the beginning of this conversation, you talked about the the longer range outlook for growth being connected to global GDP. I suppose one of the counter arguments about that rate of growth is climate and the effect of aviation, on the climate, on emissions as a relatively high emitting industry. Is CAE doing anything to try to mitigate that, to kind of help the social license part of the aviation sector?
Well, absolutely. Look, I would just start by saying that there's nothing more ecological than training in a simulator. and why do I say that? Because there's still opportunity to grow the amount of training that's done synthetically through simulators, and a lot of that's in the military. The military, I was in Alabama just last week, where we trained all. I talked about how many pilots we do in the U.S. military. So we trained all the U.S. Army fixed wing and vertical rotary wing pilots in Alabama every year. And although we have a huge infrastructure there in terms of simulators actually flying real helicopters, still only about 50% of the training is done in simulators in that military operation. So room to grow there, so continuous dialogue there. Ourselves specifically, I mean, we're known for simulators, obviously, but less known is we're actually the top world producer of pilots for themselves, with contracts with airlines around the world to take a person off the street and make them an airline pilot. And for that, we use a lot of airplanes. So we ourselves are converting our airplanes. We're doing the STC, the supplemental type certificate, ourselves to basically transform our fleet of aircraft that we have to electric power. So we're doing that. And if I go back to aviation, I mean, in terms of the amount of people, using airplanes every year, about half, or actually 2/3 of the world's population travels, in terms of numbers, in aggregate, not the number of people, just the aggregate number of hours every year travel by aircraft. So it's an essential component of, the global economy. And that's not going to change. What is going to change is what the airlines are doing, and the whole the industry is doing. I don't think there's an industry that's doing more to achieve their climate growth. A lot of it has to do with sustainable aviation fuels. And that's a very strong driver. And of course, transforming the fleet of aircraft that are out there to engines that produce a lot less, or at least a lot less fuel burn, better fuel economy, which of course has profit potential in there. And of course, the number one reason is ESG reasons.
Given the defense side of the business, is war good for your business?
Nobody's gonna be happy about geopolitical issues around the world. And to be, if you've lived through the Cold War, a lot of us have. To me, you have to believe that making sure that our men and women, are in uniform, are ready, have a high level of readiness to ensure deterrence. That is very important, and we're at the epicenter of that, to make sure that we believe it is our noble mission in defense, to make sure that men and women in uniform are ready to be able to accomplish their missions and return home safely. But again, nobody's going to be happy with geopolitical issues around the world.
All right, I guess we've got time for one more question, which looks into the future. What do you think is the most important or potentially most transformative technological shift that you're going to see in your sector coming forward?
Well, I think it's the same as everybody. I think it's AI. There's no doubt about it. For us, what we are doing, what we're using technology for, and we're number one in the world at technology for flight training, as you would expect. So what we are doing is using technology, AI being a big one, to be able to make sure that the pilots that are flying today, that are going to be generated, these 284,000 pilots that we're going to generate our next, basically 10 years, how are we going to give them the experience to be able to know they can fly and maintain the safety record that they have? And for that, we're using technology like AI to give us objective data assessment of the skills of those pilots.
We have to wrap it up there. Marc Laurent, thanks very much.
My pleasure. Thank you.
Please welcome to the stage Isabel Marco, Executive Chair of the Board at TC Transcontinental, for a conversation with Bloomberg's Mathieu Dion.
Bonjour, Isabelle Marcoux.
Hey, bonjour, Mathieu. Such a pleasure to be here. Thank you for inviting me. Thank you to National Bank and Bloomberg.
It's great to have you. TC Transcontinental is the largest printing business in Canada. You actually print the Globe and Mail, the Toronto Star, and wait for it, the National Post. So pretty much every major newspaper business in Canada. But you did a pivot in the past few years, and we talked about that. You're in packaging now. And the company is listed on the Toronto Stock Exchange with a market cap of 1.5 billion Canadian dollars. Isabelle, as a Quebec-based journalist, I know your company, but tell us your story, because it's a family story also, but tell us your story over the past decades, and stop at 2014. You'll understand why.
Perfect. So Transcontinental is a second-generation family-controlled business. It's publicly listed on the TSX. It was founded by my father in 1976, so 49 years ago. Our origins are in printing, and we are still the largest printer in Canada today, and have a sector that's evolved, actually, so not traditional printing. In the years 2000, we were the largest community newspaper publishers in Canada and the largest women's magazine publisher. As we saw advertising declining, we decided to sell that business. It was a right timing for us to exit that business, and the multiples back then were still very attractive. We sold our media sector at a price that today we could not get. 2005, we had huge cash flows from our printing business and decided to invest in digital. That did not last long. We failed fast. We exited, and we're faced with the decision of very strong cash flows from a printing business. So either continue run the business or reinvest those strong cash flows in a new business. So 2010, we had a decision to make, and we decided to invest into packaging. So I'm stopping here, Mathieu, as per your instructions.
So it's interesting because you weren't printing mainly, and then you decide to pivot to say, hey, we need some kind of new business model here. What triggered that? Because you feel that printing was going to fail you at one point over time?
So printing back then was declining, although it was still producing very strong cash flows. And as a public company, you're condemned to grow. So we looked at the packaging sector as a way for us to continue growing our business. Today, packaging represents 57% of our revenue and is $1.2 billion of revenues for Transcontinental.
So your company has a dual-class ownership structure, and your family controls the company, the Marcoux family. Was it more difficult or easier to do this pivot with this structure?
I would say it was easier. There's a perception that family-controlled businesses are slow, are emotional, are indecisive. It's actually not my experience at Transcontinental. We do look for the long term. We do look to create long-term value. However, we've been able to take decisions very quickly and act swiftly. I'm also on the board of George Weston that owns Loblaws. Same experience. You see what Loblaws done, acquiring Shoppers Drug Mart, acquiring real estate. They've expanded. They took decision quickly. They seized opportunities. I was on the board of Rogers. The Shaw acquisition was a milestone. I'm on the board of Power Corporation of Canada. Same long-term view, but swift decision-making. So I actually think family-controlled businesses can balance the long-term and the short-term quite effectively.
I guess that during this pivot, there were some challenges. What were the lessons learned there during this transformation?
I would
from
say,
a governance perspective.
So good governance has been very important for us. Lessons learned, surround yourself at the board level with great people, people from different backgrounds, from different experience. Gender diversity has been very important at our board. So we have a board that's independent, 8 board members, over 11 are independent. The 3 others are myself and my 2 siblings. We have 5 women out of 11 on the TC board. We have board members that have a variety of backgrounds, whether it be manufacturing, finance, retail, marketing. We also have a lead director that acts as a link between myself as executive chair, my family members, the other independent board members. So really good governance, bringing decision-making that is astute, fast, and quick.
I want to learn more about family-controlled businesses because we have a few in Quebec. Power Corporation is top of mind, controlled by the Demers family. What are the benefits of those family-controlled companies overall?
I think the benefits are alignment. So families in business are completely aligned with shareholders to the extent that they work to create value over the long term, but also in the short term. The benefits also have been demonstrated by National Bank. So it's not just me saying that. They have what they call their annual Family Advantage Report. And they show that family-controlled businesses in Canada actually have superior returns. It's 700 billion in market cap that family businesses represent in Canada. It's 1 million Canadian that work for family business. So it's really a cornerstone of our economy in Canada.
In terms of governance, though, many shareholders, and I've talked to shareholders in New York, they have concerns about family-controlled businesses in Quebec. You have advisory firms like ISS and Glass Lewis advising against voting for family board members. Don't you agree that there could be some conflict of interest sometimes where a family board will not necessarily act in the shareholders' interest, but their own interest? And we can see it in M&A sometimes, where you have a company that doesn't want to sell because they want to keep the business in the family.
So a few things on that. I think, as I said, I think family businesses are aligned with shareholders because they seek to create value. Families in business, however, need to have legitimacy to control the business. And legitimacy, to me, stands with credibility. You have to be credible to run the business and hence legitimate. So going back to the board, it's so important to have a strong board, a board that's independent, a board where the voices of board members are heard and listened to. And that's certainly been my experience at TC Transcontinental, where we have a credible board, we're legitimate to run the business, and we deliver results.
Let's go back to Transcontinental. Where do you see value in packaging going forward? Talk to us about what you do in packaging more precisely, and where do you see value there? It's plastic packaging, right?
So it's plastic. So plastic has been demonized. People don't like plastic. However, the benefits of plastic are often underestimated. If you think about plastic, it's light, it's small. If you think about the cost of transporting plastic, it's very low. If you think about the benefits of plastic in terms of shelf life, it's unbeatable. So 80% of our business is packaging food. We package cheese, we package meat, we package coffee, tobacco. There's nothing like plastic to extend the shelf life of these products. So there are great benefits to plastic. Now, come with plastic is recyclability. Plastic needs to be recycled, and that's the challenge. So how we've tackled this challenge is really investing heavily in research and development. We have a team that's second to none. We've opened a facility last month in Spartanburg where we have a film that is fully recyclable, and really we're going to the market with that film with success. So I would say 2 words: sustainability, recyclability, and the benefits of plastic.
So plastic or packaging is more promising here than printing somehow.
I would say we have 2 strong sectors. In packaging, we're able to serve our clients with great products. In printing, we've really also pivot that business, focusing on the retail sector. We've been out in the market with a new product that's called Radar. So we were traditionally a printer of flyers. Canada is a flyer country. People love deals and they look to the flyers for the best weekly deals. We launched 2 years ago this product, which is called Radar, which is a compilation of flyers serving large retailers. So we distribute today 5 million copies of that product weekly in Quebec, the Atlantic provinces, and British Columbia. So serving the retailers to help them bring their customer in the store. In printing, we also do in-store management. So once customers are in the store, they need to have a great experience. In-store marketing is about display into the store. So for us, it's a very synergetic. It's the same client base. So we serve Metro, Loblaws, Shoppers Drug Mart, Canadian Tire with flyers and in-store management. So in print, again, we've pivoted, and we see a lot of opportunities to continue growing in in-store marketing. We started from scratch, from zero. Today, it's a bit less. Less than 300 million. So.
It's interesting because in printing, we should not only think about printing like newspapers. You can also print like cardboards in shops and like
absolutely
many avenues there that will remain despite.
Yeah, that's actually growing.
Yeah, exactly.
Because retailers want to have the customers that they bring in the store. They want them to have a great experience.
Most of your packaging business is in the U.S., right?
So we have 26 plants in packaging, 16 in the U.S., 5 in Latin America, 3 in Canada, 1 in the U.K., and 1 in New Zealand.
And most of the revenues, about 60% comes from packaging.
Absolutely. So packaging for us, we entered packaging in 2014 because you had me stopped at that date. Why we chose packaging, we were pretty good at printing on paper. We felt we could print on plastic. We were pretty good at serving large customers in Canada, and that's what we do in packaging. We do serve large customers, Coca-Cola, Mars, P&G. That's the profile of our customers. We were pretty good at managing a network of plant in Canada. That's what we do now in the US and Latin America mostly. And we chose packaging because it was a sector dominated by some few strategic companies, but also private equity. So there was a room for consolidation. Since 2014, we did 10 acquisitions in packaging, yielding $1.2 billion in revenues.
So most of your revenues are coming from the U.S. Are you more of a U.S. business now than a Canadian business?
We have more revenues coming from the U.S., and we're still very Canadian at heart.
Okay, that's important. I was looking it up on the terminal, and we have the analyst consensus rating, and they are bullish on your stock with a buy recommendation. Your stock price went from $10 a year ago, now it's nearing $18. It's up YTD by 30%. What moved the needle in the past year?
Yeah, so we're very proud about the stock trajectory in the past year. It's been fantastic. I would say the answer is focus. Last year, we put in place a new management team, new CEO, Thomas Morin. I took additional responsibilities, so did our CFO. And we decided to focus on 3 things: profitability, lowering our debt, so cleaning up our balance sheet, and having a higher ROI. So increased profits, cutting SG&A, working on cost of goods sold, and turning around underperforming assets. ROI, obviously stronger cash flows, less CapEx, more ROI, more comparable to our competitors. Cleaning up the balance sheet, that's working on working capital. Selling some real estate, which were no longer of use, and allowing us to put in place a share buyback. So I think the combination of that proved to be very powerful for our first last quarter. Were increased year over year, and it's been busy, and it pleased our investors, and we're super happy about the uptick on our share price.
So you did many acquisitions over the past decade to grow in packaging, and you did. Pretty amazing pivot there. Are you on the hunt still for M&A?
So there hasn't been much in the flexible space in the past 2 years. Not many opportunities, not many companies have been for sale. We see a bit more activity right now. We have a balance sheet that will allow us to be a participant in the industry. We see packaging acquisition and also acquisition in ISM. We will also continue to prune our portfolio. We want to be in the higher growth, higher profitable segments in packaging. So those segments that do not correspond to those criteria, we will look to divest. So I would say we'll be active on both fronts.
Okay, and what's your number one priority in all of this?
Our number one priority is to continue increasing our profits.
Okay.
Yeah, we're in a low growth environment. Printing is not growing at a fast pace, neither is packaging. Packaging volumes are slightly up. However, there are pricing pressures, so we're in an environment where we need to continue increasing profitability through programs of continuous improvement, operational excellence, commercial excellence.
Great. Isabelle Marcoux, thank you very much for this great conversation.
Please welcome to the stage Patrick Decostre, President and CEO of Boralex, and Wyatt Hartley, Managing Partner and Chief Financial Officer of the Renewable Power and Transition Group at Brookfield Asset Management, for a conversation with Bloomberg's Noreen Malik.
Hi, welcome to the Advances in Renewable Energy panel. With me is Patrick Decostre, Chief Executive Officer of Boralex, and Wyatt Hartley, Chief Financial Officer of the Renewable Power and Transition team at Brookfield Asset Management. To start off, why don't you just give us a little bit of background about yourselves to put everyone in the same room as you?
First, I am with Boralex since 23 years, sorry. I worked for Boralex 18 years in France. I was the first employee there, and I moved to Canada 5 years ago.
And tell us a little bit about Boralex, like the mission.
Yeah, Boralex is a renewable IPP. We are essentially, we have assets in Canada, in France. In the UK, we are building our first asset. We have a team there and growing there. And we're also in the US. So in wind, solar, small hydro, and we're building large storage presently in Ontario.
Got it. Wyatt?
Wyatt Hartley, I'm managing partner at Brookfield. I've been with Brookfield for 15 years. Brookfield Renewable is a global owner and operator of renewable power assets primarily. We have 35 gigawatts of operating capacity, another 200 gigawatts of development pipeline. We're diversified across multiple technologies, hydro, wind, solar, more recently investing in batteries as well. And across multiple technologies, the majority of our business is in North America, but also a very big presence in Europe and some other areas in the world. And then incrementally, we've also been investing into the energy transition. We own Westinghouse, which is one of the largest global servicers and technology provider behind the nuclear sector. And then very small and prudent investments in carbon capture, sustainable aviation fuel, and biofuels.
And given what a Newsweek we've had in the power industry with the hyperscalers coming in on nuclear, tell me about AI, Wyatt, and like what priority is that for you and how are you chasing that?
Yeah, look, I think the way I would contextualize the AI demand and the hyperscaler demand is that ultimately these companies are becoming infrastructure companies, reluctantly really, in the sense that they don't want to be infrastructure companies. They want to be technology companies. They want to focus on their core product. But in order to ensure that their product gets to market, they have to ensure that the infrastructure exists. And the reality is the infrastructure does not exist right now, and they're having to build it out. And it's creating a very meaningful amount of demand, not only for renewable power, but broader infrastructure like data centers, semiconductors, what have you. And from a Brookfield perspective, we're very lucky that we are positioned to be a servicer across all of those things. I work in the renewable power sector. I mentioned that we are a a very meaningful developer of wind and solar, which is a product they require to build out their data centers. Incrementally, we own Westinghouse, which is going to service the existing nuclear power will service their data centers, but in terms of servicing the incremental demand they have, nuclear, as you referenced the news that has been discussed today and other announcements previously, that looks like it's going to be a big part of servicing that going forward. But we also in our infrastructure group, we are one of the largest owners of data centers globally. We have a partnership with Intel where we're providing capital to help them build out semiconductor capacity fabrication of those products in the U.S. So the ability for Brookfield to provide a holistic solution to the needs of these companies is very differentiated. And so we're fortunate enough to be one of the few partners that they could focus on globally to service those needs. And we're lucky enough to have announced earlier this year on the renewable power side of our business a partnership to develop 10.5 gigawatts of wind and solar for Microsoft from 2026 to 2030. And that's just one of the partnerships that we have with the large hyperscalers. We have a number of other partnerships with the other guys, but ultimately we're quite confident that not only will we deliver that 10.5 gigawatts for them, but we're very uniquely positioned to deliver beyond that, and again, across the multitude of services that they require.
And another one for you in terms of like AI and developing the renewable energy transition infrastructure for them. Where are they in your priority? Are they the top priority now? Like, what did that compare to like a couple years ago?
Yeah, look, they've been a very meaningful priority for us for a while. I feel like for the last 3 years I've been talking about the tech demand, and not only, I think the thing that I think is sometimes misplaced, it's not all AI, right? If you look at the power demand increase that these businesses have had over the last 5 years, which was really driven on the use of cloud and the digitalization of our economy, that trend will continue, and then AI obviously augments it and creates an additional need. So this is something we have been seeing and have been positioning our business accordingly for the last number of years. And it's really as these announcements over the last year, really, where we found that the market has really reacted to it. But our focus has been for a while. And look, I think the easy way to contextualize it is, all our customers are our priority. We've always been focused on ensuring that we are providing our corporate customers the best services that we can, because ultimately we're competing on a strategic capability we have, not just the cost of capital. And so, those corporate customers have been critical for us. But in a market where, for the first time in 5 to 6 decades, where electricity demand in the U.S., as an example, is seeing very meaningful and sustained increases, and that's primarily being driven by the tech companies, of course, that's going to be a priority for us as a business.
And Patrick, are you tempted to come to the U.S. by chase AI, or what are you seeing in your territory, and where are you focused?
Yeah, we are developing in the state of New York specifically, not chasing AI, but with the off-taker, which is NYSERDA. It's the administration from the state of New York. It's a complex off-taker, so it is a priority, but it's going slower than expected 5 years ago. Where it's accelerating a lot, it's Quebec and Ontario, where if you go back 3 years ago in 21, in our strat plan, it was a small part of the growth. And with different changes which are essentially driven by the electrification of the industry, of transport, and the growth of the economy, generally speaking, the plan of Hydro-Quebec and the plan in Ontario are, we are speaking about $150 billion investment. So if we take a small part of it, it will be a big development for us in Quebec and Ontario. In Quebec, we have signed, the last 3 years, we have signed 1.8 gigawatt of contract. We operate 3.1 gigawatt today, so it's very significant. In Ontario, we have signed 0.5 gigawatt in storage. Again, there is other tender coming, and our advantage there is the knowledge of the grid, the knowledge of the community, the knowledge of the First Nations, and the fact that we are in this situation. So it's a smaller number than obviously what Brookfield is doing, but it's interesting margin. And what has changed completely, I think, is if you go back 5 or 10 years ago, renewable were growing due to RFP and niche created by government to reach target. No, it's driven by the real economy.
Can you talk about just the relationship between your customers, whether it's like if the nature of the PPAs are changing, the tenors, or what kind of role they're taking in like how you're structuring these deals, if that's changing? If you start, Patrick.
Yeah, what we see, and it's different market by market. If we are the largest independent player in France, and what we have old assets that I start in probably 2002, 3, 5, and so these assets have had a period of contract with the EDF as an off-taker, came to an end, and then we're signing what we call brownfield PPA. So this is 3 to 5 years contract, and what is driving the corporation to buy this electricity is to have green electricity without additionality. We are also signing greenfield PPA for new assets in France. We just announced one last week with Nestlé for three sites. And this is, Nestlé is 15 years, sometimes it's 20 years. This is financeable, and this is with additionality. So the idea is to reduce the scope 2, and this is what is driven the market today. And it's an option compared to the RFP from the government, from EDF. And in Quebec, it's still RFP from Hydro-Quebec, but we went from 20 years contract to 30-year contract because of the duration, so we can amortize on the longer duration, finance on the longer duration. There is project finance available for that. So this is changing also the cost at the end for the customer.
What about you, Wyatt? I mean, you seem to indicate that the relationship with hyperscalers and maybe even other customers is changing.
Yeah, look, I think Patrick said it really well, where, to use the parlance that we use, is that our sector, the renewable sector, has gone from a government push, so RFPs, contract for differences, government's feed-in tariffs, to one that is primarily driven by a corporate pull. And as I mentioned, for us, this has been a huge focus for our business, because we just find, as an organization, we do a lot better working with corporates, because it allows us to really bring a strategic element to the game and earn what we find a better risk-adjusted return. And so, from our perspective, we've been in this market for a long period, been developing relationships, and really we've seen it augment over the last number of years to where you're seeing it now, where we have close to 1,000 customers across our portfolio. Around 30% of our generation currently is servicing commercial and industrial load. By the end of the decade, within the next 5 years, that will probably be more than 50%. So just a sense of the majority of our growth is really focused on that commercial and industrial load. And I think to Patrick's point, it's not just for the green attributes, it's not just for energy security, it's driven by the economics that in the majority of markets, renewables are the lowest cost bulk electricity available. And so when you have that behind your sector, that's a really powerful thing. And really that's why we've seen the kind of meaningful growth in our business and the amount of development we're doing. In terms of your question around the contracts, and Patrick mentioned this, from what we're seeing is there's no shortening of contracts, because ultimately what we've seen from our customers is they want the lowest price they can get up front. And what the trade-off is a longer duration contract generally allows for a better financing package, which allows a lower price to them up front if you're selling back for the same return. So from a contract perspective, we're not seeing a shorter or riskier contract. It's more or less the same as what we saw in our sector 10 years ago.
Yeah, I think a few years ago, the push was for like maybe 10 years, 5 years, but are you seeing more like 20, even 30 years? Like what's the sweet spot right now?
Yeah, look, from what we're seeing, it's dependent on market, it's dependent on customer. like often what we are negotiating with our customer when it comes down to it is duration. They're not changing on price, and they're saying, we'll give you an extra 2 to 3 years, and that will make the math work in terms of solving back for the returns. So it's really driven by contract or driven by market, but we're generally seeing 20 years plus is the average duration.
Oh, go ahead. Yeah.
No, maybe one thing which is illustrated by Wyatt is what has changed is in the past, the added value was developing the best project for the RFP of the government. And today it's really driven by the end. So the fact that we have commercial team who understand the real needs of the different customer in the different market and be nimble to change contract. We have, for example, in 2022, we have early terminate contract for 10% of our installed capacity in France just to switch from the regulated contract with EDF to other contract with another utility, and we have created a lot of value with that. We have never imagined that 10 years ago. So this is an example. There is a lot of value in this part. When you're discussing with customers, they're all asking different things. Even if we are selling a commodity, they're asking for another way to marketing, another way to guarantee the electricity, another way to pay, to be firm or not, and this is creating lots of value if you can keep them in-house.
Can you give us a sense of like the economics? Like a few years ago, the PPAs were like low teen returns or even single digits for solar and wind, and you saw power prices just kind of like get down into the $30, $40 per megawatt range. What is it now? Like, given supply chain issues and interest rates, what makes you comfortable?
Yeah, look, the way I would say it is we've always allocated capital with a target return, equity return of 12 to 15%. And ultimately for us to invest into development where you are taking on a higher risk than buying operating assets, we're going to need to see a return at the high end of those returns. 5, 6 years ago, we weren't doing a lot of development. Now we're commissioning 7 to 10 gigawatts per year, and that's really driven by a better return environment that's within that range that I mentioned and generally at the high end.
Yeah, it's the same situation. If you look to, in France, you can, on the last 3 years, the price which is public, the average price of the tender increased by 36%. In the UK, in the last 2 years, it increased by 20%. I can say the same in Canada about the return. We are reaching this 12% return, and so it's interesting because it's completely different than when the price and the cost were going down. It was good when you have an asset, you can refinance, you can do things, but at the end you don't know where it would stop. No, it's a completely different situation.
What is the biggest stumbling block to your growth or to your goals right now? I mean, there's a delay on transformers. There's a delay on getting, like, you're not developing gas, Patrick, but like, or maybe you are, but natural gas turbines. There's a long list. Labor is getting harder. What concerns you the most?
Maybe I think first social acceptability, and I think and grid are the main long-term, because you can do something on equipment delivery. The supply chain can improve. I think what is important is that the general population understand that it's no more a subsidized business that we have to do because it's green. It's something that is important for the economy. And so this is important. So planning consent on grid, planning consent on project, less recourse on project, and transform what we have here in New York. We get contract, but we're not able to transform it into project because NYSERDA is a little bit complex, and when I say we, it's the industry, okay? So that is also something which is important.
Yeah, look, from our perspective, we've really been focused on diversifying our business for a number of reasons. The primary being is that really allows us to deliver the best product to our customer given the specific needs they have. But it also means that we're in a fortunate position that there's nothing individual that really creates a concern from our business. So from a risk perspective, there's a lot of benefits. I would echo what Patrick said, though, is generally, because every market is different, but across most markets, the the limiter to new build is grid and interconnections. But look, that creates an opportunity where if you have projects that are well positioned in terms of in the interconnection queues that have affordable interconnections that make your projects viable, there's huge value to that, and we're very fortunate that we've positioned our business so that we have those interconnection positions, those projects available in the most attractive markets around the world that are looking for corporate demand, or that there is corporate demand, and so it creates a huge benefit for our business of having that.
Awesome. And I think we're just about out of time now. Thank you both gentlemen for sharing your thoughts, and let's keep the conversation going.
Thank you.
Thank you. Thank you, Ed.
We're going to take another quick break, so feel free to stretch your legs, and we will resume our program shortly. Thank you.
I just wish that I could give you that look that's perfectly unsad. Sometimes all I think about is you. Late nights in the middle of June. He always been faking me out. He always been faking me out. Sometimes all I think about is you. Late nights in the middle of June. He always been faking me out. Can't make you happier now. Sometimes all I think about is you. Late nights in the middle of June. He always been faking me out. Can't make you happier now. Something's got a hold on me lately, though I don't know myself anymore. Feels like the walls are all closing in, and the devil's knocking at my door. Whoa, out of my mind, how many times did I tell you I'm no good at being alone? Yeah, it's taking a toll on me, trying my best to keep from tearing the skin off my bones. Don't you know I lose control when you're not next to me? I'm falling apart right in front of you. Can't you see? I lose control when you're not next to me. Yeah, you're breaking my heart, baby. You make a mess of me. Problematic. Problem is, I want your body like a fiend, like a bad habit. Bad habits hard to break when I'm with you. Yeah, I know I can do it on my own, but I want that real full moon, black magic, and it takes two. Problematic. Problem is, when I'm with you, I'm an addict, and I need some relief. My skin ain't your teeth, can't see the forest through the trees. Got me down on my knees, darling, please. Oh, I lose control forget where I'm from. Cause looking in your eyes, like looking at the sun. I feel like you're the moon, I feel like I'm the one. I wanna get numb, 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 numb. I wanna get numb and forget where I'm from. Cause looking in your eyes, like looking at the sun. I feel like you're the moon, I feel like I'm the one. I wanna get numb, 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 numb. Wanna get numb, go crazy, wanna wild out. Cause lady, life's so short but amazing. Late night party in the basement, hotel lobby and I'm wasted. Just reached into my savings, I'll do it too if you take it. Yeah, life's only what you make it. I wanna get numb and forget where I'm from. Cause looking in your eyes, like looking at the sun. I feel like you're the moon, I feel like I'm the one. I wanna get numb, 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 numb. I just wanna get lost tonight and dance with you. I just wanna get way too high, let's set the mood. You're my fantasy, yeah. I don't wanna fall asleep yet. There's nothing in this world I'd rather do. I wanna get numb and forget where I'm from. Cause looking in your eyes, like looking at the sun. I feel like you're the moon, I feel like I'm the one. I wanna get numb, 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 numb. I wanna get numb and forget where I'm from. Cause looking in your eyes, like looking at the sun. I feel like you're the moon, I feel like I'm the one. I wanna get numb, 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 numb.
We were good, we were gold. Kind of dream that can't be sold. We were right till we weren't. Built a home and watched it burn. I didn't wanna leave you, I didn't wanna lie. Started to cry, but then remembered I can buy myself flowers, write my name in the sand, talk to myself for hours, see things you don't understand. I can take myself dancing, and I can hold my own head. Yeah, I can love me better than you can. Can love me better, can love me better, baby. Can love me better, can love me better. Paint my nails cherry red, match the roses that you laid. No remorse, no regret. I forgive every word you say. Ooh, I didn't wanna leave, baby. I didn't wanna fight. Started to cry, but then remembered I can buy myself flowers, write my name in the sand, talk to myself for hours,
Please take your seats. The program will begin in 5 minutes. Please take your seats. The program will begin in 5 minutes.
I don't go out, but I do it for you. You never liked to wanna drink too much. I hate to dance, but I'll dance with you. 'Cause I do anything to feel your touch. Don't let anybody tell me why it's different with you. Don't believe in love, but no one makes me feel like you do. I don't say it much 'cause I just always thought that you knew. It's what you do to me. I'm wrapped around your finger, can't stop. You know I got a soft spot for you. You know I got a soft spot for you. Baby, can't you see? I need you 'cause you're everything that I'm not. You know I got a soft spot for you. You know I got a soft spot for you. Too late, don't wanna fall, baby. I just don't need somebody else to throw me aside. But I'm up all night thinking about how it could be you to change my heart. But I don't let anybody tell me why it's different with you. Don't believe in love, but no one makes me feel like you do. I don't say it much 'cause I just always thought that you knew.
Please take your seats. The program is about to begin. Please take your seats. The program is about to begin.
Can't you see? I need you 'cause you're everything that I'm not. You know I got a soft spot for you. You know I got a soft spot for you. It's what you do to me. I'm wrapped around your finger and I can't stop. You know I got a soft spot for you. You know I got a soft spot for you. I've got sunshine. I've got sunshine. I get you say what can make me feel this way, my girl, talking about my girl. I've got sunshine. I've got sunshine.
Please welcome to the stage Alexandra Laurent, President and CEO at WSP, for a conversation with Bloomberg's Melissa Shin.
Welcome back. We are in the home stretch. Thank you so much for joining us for this invigorating day of conversations. And I'm so pleased to be here with Alexandre. Welcome.
Thank you so much. Pleasure to be here.
Great. And I know congratulations are in order. On October 1st, you just closed the acquisition of Power Engineers. And I know that's a culmination of a lot of growth lately. So maybe tell me a bit about WSP's story and growth.
Yeah, indeed. It's been, the last decade has been quite busy on the growth front for us. We IPO'd the firm in 2006, and really in 2010, after we had really built our national platform in Canada and had a presence in each and every province, we said, look, it's now time to spread our wings and go abroad. So since then, we've been busy building our platform globally. So today, WSP is a firm of close to 80,000 employees, in excess of $10 billion of net revenue, 14, I should say, in gross. We're in 50 countries. We have a leading position in property and building globally. We designed the Freedom Tower here in New York, the Shard in London. We have a leading presence also in transportation, infrastructure, California high-speed rail, HS2 in London, hopefully one day the HFR in Canada. And then more recently, in 2000, we decided to build our pillar in Earth Environment. So we announced that we wanted to become the leading firm in the green transition. So today we have 20,000 strong professionals in that sector. And more recently, as of last week, we had announced 2 years ago that we really wanted to build that power and energy sector. So we completed the acquisition of Power Engineer, which is a leading brand in the energy transition, US-based firm, and we're extremely pleased about that.
Oh, it's very exciting, and a lot of big names that you just named there. You've done a lot by this acquisition, but there's also organic growth. So when you're thinking about growth, how do you balance both of those types of growth?
Well, organic growth is the heart and blood of an organization. So yes, I started with the merger and acquisition, but the reality is, since our IPO, we've never had a down year in organic growth, with the exception of 2020, when all construction sites worldwide shut down, and yet I think we generated negative 2% organic growth. So we have a very resilient platform, given the sectors that we're in, but also the project mix, public, private sector, and also the project sizes as well. So today we have 200,000 live projects around the world. So if you want to have exposure to the infrastructure space, but you do not want necessarily to have exposure to one project and have the diversification, I mean, WSP is a good mean for that.
Okay, that's good to know. And in terms of continuing to perhaps grow by acquisition, do you have anything in the works? Is there a genre that you would be looking at for what's next?
Look, we have a very strong capital structure, very good balance sheet, and it's always the goal on the back of an acquisition to come out with a strong balance sheet position, because historically we have found ways to be opportunistic, and I want to continue that to be the case. So yeah, we're clearly open for business. Obviously, we just completed one 2 weeks ago, and I think I want to be busy in the next few months generating shareholder value for our investors, and it starts with a good integration. So we're busy already doing that, but clearly I think the next few years should be very exciting for us.
Fair enough, fair enough. And when you think about that sort of integration with a new organization, one that's US-based, what are some of the cautions and concerns that you might have, and how are you mitigating those?
Well, for us, every time we complete an acquisition, and we've completed north of 100 in the last decade, is really 4 very simple criteria. Obviously, number one, the price has to be right. If we're not creating shareholder value, we're not going to do it. But close second is the culture. Very quickly, we want to make sure that our culture are aligned, the respective organization cultures are aligned. We want to make sure that we have a shared vision of what the industry should look like, where we want to go as a company. And lastly, and that's oftentimes that criteria that people omit or forget, is can you integrate it? You, on paper, may be the best deal ever. It may make all the strategic sense in the world, but oftentimes the operating models are different, the views are different, and even though you tick all the boxes, you just know that you're going to destroy value. So we're quite mindful of that, and we're quite careful. So obviously, a lot of the work with Power Engineers has been done upstream. I've known the firm for more than 10 years. I've spoke to 3 CEOs prior to completing this transaction. This was my 3rd CEO, the reign of Power Engineers. So every time you have to rebuild the relationship, but I know the firm extremely well, so I was highly confident and I had the strong conviction that this would be a good deal for us.
Well, that sounds like a lot of due diligence, but well done.
Yeah, thank you.
Great. And then, of course, you mentioned the growth trajectory and the success that you've had. What headwinds do you see in the future?
Look, right now, you look at the trends supporting our industry. I've never seen that in my career, in the sense that you look at demographic changes, growth in population, climate change, social concerns as well, what population is looking for, or a resident of various countries where we operate. So all those catalysts are fueling our industry and are fueling our company. I always like to say that you're never going to call your advisor or your consultant if there are no catalysts in the marketplace. When things are steady, you don't tend to pick up the phone and call your consultant, your lawyer, so it's the same thing for us. So there are many catalysts happening in the world right now. So I think it's on one end very positive. On the other, climate change, it's hard to ignore. And you see what happened last week in Florida, and that is only going to continue. And that brings, unfortunately, in that case, a lot of work to us.
Sure.
And then, I mean, the concern obviously is geopolitical right now. Hard to ignore. Lots of political, I wouldn't say instability, but a lot of concerns in many developed countries right now. And this year, more than half of the world population has been or will be voting. Yes, so that brings sometimes some delays, concerns, change of government, want to do things differently. So it's difficult to ignore. But for us, I mean, if I take just where we're sitting here today, WSP Global has done extremely well under the Trump administration, and we've done equally well under the Biden administration. So we're agnostic, frankly. We're feeling comfortable with our position in the marketplace, but nevertheless, it's something that you need to watch for.
Yeah, that makes a lot of sense. Okay, talking now a bit about your clients' priorities. So it's 2024, which means we're very close to 2030, which is the deadline for a lot of, shall we say, aspirational climate goals. A lot of folks talked about 2030 sustainable development goals. And so when you look at your client base, what are you seeing in terms of readiness for 2030?
Challenging.
Yeah.
To say the least. I mean, without naming names, but I was with a client on the West Coast last week, one of the hyperscaler, let's put it this way, and had plans for 2025, and they said, Alex, we're not going to make it. It's too difficult. We had not planned that we would need so much energy with the AI and everything that is happening. So it's clearly a challenge, but it's not because it's a challenge that I think people are giving up. I think the board rooms are still committed to it and are quite concerned. And it's not because the goal is difficult to achieve that people are giving up. Some are revisiting their position, but for the most part, our clients are quite focused on it, I must say.
Okay, yes. I mean, what you've said is not surprising. What are some of the concrete steps that you see or are advising some of your clients to take to get closer, maybe not 2030, but something else?
But just take the mining industry. I mean, you take, again, without naming names, take all the large players, Rio Tinto, BHP, they're laser focused on ways to decarbonize the industry and ways to extract resources in a cleaner way. And again, back to my earlier point 10 minutes ago, that's a real catalyst for this industry. Water resources also is a big catalyst for this industry. So we are supporting them, next to them, to really think about how we can electrify the transportation of those resources from the mining pit to the ports. And not so long ago, those companies were not thinking about this. So it's changing, and it's changing rapidly. And that's why I think it's a good period for us.
Okay. And you mentioned earlier the vast energy needs of AI, and you also mentioned electrification of mining. And there's been a lot of headlines about how people may not realize how much electricity is eaten up by this digital transformation. And I know that WSP is also a priority for you with your clients, is helping them through their digital transition. So yeah, tell me about how you're kind of reconciling that challenge with also everyone's sustainability goals, including yours.
Well, it's extremely hard. It's extremely hard to, because we're at a crossroad, right? I mean, with AI today, a data center is essentially consuming, the consumption of data center in terms of energy it's 50 times more than a normal building. So huge energy consumption. We talked about the EV and electric vehicle, but the reality is this is a drop in the ocean compared to what we're talking about here. Just the data center consumption in the next 2-3 years will amount to or equal with Japan. So the amount of electricity and energy that is going to be needed is going to be great. And right now, what we're seeing also is this competition for energy, the old industries or the existing industries and this new industry, and the clash that this is happening. So we're obviously here. We're not taking side, and we're here to support our clients. And really, at the end of the day, WSP and the acquisition of Power Engineer, the whole thesis behind this is to be in a position to connect new sources of energy or connect existing grid to new demands, essentially. So that's our role in the society, and if we can do it in a clean way, I mean, that's obviously our goal. And that's why we have a big service offering, obviously, on the renewable side.
Got it. Sort of on that idea of perhaps fragility, you mentioned Florida, and we've just seen in the past decade and longer, but very acute issues with the fragility of infrastructure. What are you seeing as sort of the low-hanging fruit in terms of shoring up our infrastructure system to be more resilient?
There are many. I haven't discussed that today, but cybersecurity is one of them. We always talk about cybersecurity in the context of companies, but we also need to think about them in the context of the assets that is, fueling our societies, whether it be electricity, dams, utilities. That's, to me, is probably one of the number one priority right now in the world, is we really need to protect our assets. And now, today, obviously, is very different than 10 years ago. When we design assets, we do that with this in mind, and we want them to be future ready. The resiliency as well around climate change is equally important. And again, today, and I look at some of the skyscraper that we've designed here in recent years, and you compare the way they were designed now compared to a few years back is extremely different because we know what's coming.
Okay.
At some point, I don't mean to be the party pooper here, but could be at some point part of New York could be underwater, Florida could be underwater, and we have to take that into consideration when we design asset now.
Sure. What are some examples of the improvements and things that you're doing to keep buildings safer?
Geotechnical work would first come to mind. It's no longer just raising a high-rise on the soil. I mean, oftentimes all of the work that is going underground now is immensely different than what we used to see 20, 25 years ago. So that would be an example of that.
Okay, great. Going back to the discussion of the 2030 readiness and that sort of thing, obviously no company wants to go out, make a big exciting statement, and then have to retract it and hope no one notices. And so, knowing what you know now about where things have evolved over the last several years, when clients are coming to you to talk about sustainability, how are you recommending that they think about creating goals?
Really, it's to have a long-term view on things and really to sit down and think about your strategy. I think sometimes you don't know what you don't know. So again, what the flavor of the day right now is the hyperscalers and the data centers. I don't think 5, 6, 7, 8 years ago, when they put their climate change strategy together, they really understood what they were up to. So that is very difficult to control. But where possible is really to have a long-term view, have a sit down with your team members, your clients, and really have a real understanding of where your company is going and the impact that you'll have as a corporate citizen and the world around you. And I would say that 80% of the clients that we're working with, they're doing a fantastic job, phenomenal job. There's another 10% that perhaps have not been able to foresee exactly what was about to happen, and that's the hyperscaler is an example of that. And the other 10, I mean, it's like everything in life. Some are performing and some are not. So I'd say that's what I'd say.
Okay, yeah, that makes sense. And in terms of ESG and your own house, essentially, how does your approach to ESG differ, or does it, compared to what you would advise your clients?
Actually, we want to lead from the front. It'd be very hard to be credible when you advise a Microsoft or you advise if you're not leading from the front. So we're making every effort at WSP to really meet our goal, meet our criteria, and every year, for those who are interested, because I think it's a very good document. We publish this every year on an annual basis, our ESG goals and achievement and what we intend to do. And actually, we're using this, actually what we do internally is a very good proxy to really lead and be able to advise our clients.
Sure. And what do you think it is about your methodology that resonates with your clients?
Pragmatic, I would say, and practical. I think there's a lot of confusion, and has been. I think now less so. I think we're getting somewhere at this point. But a few years back, there was a lot of confusion, and we needed to take a baby step approach with our clients, really to get from one goal to the other. And I would say that the marketplace now is a whole lot more sophisticated, and people know what's greenwashing versus what is not. And for us, it's a good thing, because I feel now that we can talk serious business and really get going with this.
Very good. Well, thank you so much, Alexandre. Really appreciate your time and also your frankness about where we are. So
thank you so much. Thank you.
Please welcome to the stage Jason Mullins, CEO of Go Easy, for a conversation with Bloomberg's Christine Dobby.
Good afternoon, Jason. Thanks for being here.
Thanks for having me.
Heard you've had a busy day.
We did.
Flew in this morning, and how many investor meetings did you say you had?
About a dozen maybe or so.
A dozen. Yeah. So he's practiced his pitch, and now he's going to tell us all about it. So Jason is the CEO of GoEasy Limited, which is one of Canada's leading consumer lenders focused on lending to clients with non-prime credit scores. You've been with the company for 14 years, about 6 years as CEO. For those in the audience who aren't as familiar with GoEasy, could you give us a sense of your business model and the size of the market that you serve?
Yeah, happy to. So GoEasy is one of Canada's leading providers of credit to non-prime Canadians. Of the 32 million Canadians that have an active credit file, about 9 million have credit scores that would prevent them from getting access to everyday financial products from their major banks. So we provide them a wide range of lending products from personal loans to automotive financing. We do it through a branch network, a digital platform, and through a network of 10,000 merchant partners when they're purchasing goods and services, and we're helping finance those transactions.
And so this is a bit of a pivot, but it's probably important for those listening in here to know that you announced in July that you'll be leaving GoEasy for a new opportunity. You're planning to stay on the board of the company, and you're also helping with the search for a successor. But can you give us an update on that CEO search?
Yeah, happy to. So I'll step down from the role officially at the end of the year. We're actively in the search for the next CEO of the company, both internal and external. I'd say we're right in the midst of that search, so well on our way and making good progress. Goals to try to have someone appointed to fully take on the position at the end of the year. But we've also got a very good management team and a very good board. We're one of the few companies, I imagine, where both myself and the former CEO are both on the board to provide extra support and guidance to the management team and whoever that new CEO is that we appoint. So we're also in a good spot where, with that quality of management, board, and good business performance, we're also not in a major rush. We need to take our time and find the right candidate.
So is there a possibility that you could have an interim CEO appointed?
Yeah, I think if we get another month or so out, probably around the time we release our third quarter earnings in November, we'll probably have a good spot to be in where we can announce what that interim plan looks like. That way, as investors wonder about what does it look like if we don't have someone appointed, they can kind of rest assured we've got a very good plan to appoint either management or board in a capacity that'll keep the business performing at a high level.
Can you talk at all about your own plans after leaving GoEasy? Or I know you'll be staying on the board, obviously. But
yeah, I'm moving on to pursue managing and running a new company, smaller company in the U.S. market, different subsector of financial services. I enjoy building businesses and want to go try and tackle some new challenges and new problems to solve. But very, very happy with where the company's at and what we've achieved as an organization. Feel like the business is in about as good a spot as possible to be able to hand the reins over to someone new. I think it also is important to be perpetually bringing in new talent, new perspective, new experiences as an organization scales. We've gone through such a massive trajectory of change that the business today is very different than the one I took over and the one that our former CEO, board chair, built many years ago. So it's in a great spot for a new person to take the mantle, and I'm really excited to be part of the board and to be able to provide that person ongoing support and advice for many years to come.
Obviously, a testament to you, the share price has done very well over time, and when you announced your departure, it did take a dip that day. It's, come back a bit, but yeah, can you just talk a little bit about kind of how you find a replacement when you're still sitting in the seat yourself?
Yeah, I think it's we're in a fortunate spot where a CEO transition is occurring when the business is doing well. When I'm in a position to be able to stick around and help with the succession planning and the appointment of a new person, being able to stay on the board and help provide guidance and support to that person. So initially, the change in the leadership mantle always comes with a state of disruption and uncertainty, and it affects the capital markets. But I think that as investors have kind of digested and understood, the business is performing well. It's not a matter of drama or change in strategy or direction, that I'll continue to be involved. I think people have become much more settled, and I think the markets understand we have a very strong management team that can carry us forward. So it's a bittersweet reality for me in that I've been 14 years with the company and 6 years as the CEO, and so feel very attached to and proud of what has been built, but also recognize that there's always an opportunity to start a new chapter and bring in some fresh eyes, fresh perspective that can help us continue this trajectory for generations to come.
So back to Go Easy itself, can you talk us through the company's financing model? Like, how do you pay for the loans that you give out to clients?
Yeah, so we're a non-bank lender. We don't take consumer deposits. We raise all of our funding through capital markets, either debt and equity. Basically, the business is funded by about 70% debt, 30% equity. In the past, as we've grown, that equity has had to come from both cash flow and issuing new equity. Today, we're in a spot where the business generates a ton of free cash flow, so we're not active issuers of new equity today. It's all funded through free cash flow. On the debt side of the business, we really borrow from two sources. One is secured debt facilities provided by a syndicate of major banks. All of the major Canadian banks are members of one of our credit facilities. So that represents about half the debt stack, and then the other half is through issuing unsecured notes in the bond market, predominantly to US and some Canadian investors. So 70% debt, 30% equity. Based on the unit economics and the economic profile of the loans that we issue, we generally get to a after-tax return on receivables of about 6 to 7%, which means we're generating about 20 to 25% return on equity.
And so during the credit cycle, the rate hiking cycle, how did both your financing fare as well as your loans to your clients?
Yeah, so we were obviously subject to a rise in rates, and that did have an effect on our borrowing costs. Having said that, we've always employed a strategy to hedge any interest rate risk and any currency risk. So anytime we've issued debt in the past, if it's been US denominated, we've always hedged the currency. And anytime we've taken draws or done any financing on the debt side, we've hedged the interest rate risk. So the effect of the rising rates on our cost of borrowing was much more slow, subtle, and gradual as we replenished and turned over our debt stack. That, of course, does have some level of effect on unit economics. But what we've found is that as our business has grown, we've been able to extract so much operating leverage that our efficiency ratio improvements have led to allowing us to sustain and or still grow margins despite a little bit of pressure from the rising cost of capital.
In terms of the interest that you were charging consumers at that time, did you dramatically raise them at all during that rate hiking cycle? And how did your clients fare?
Yeah, so like every company, you have to make this decision around when your input costs, particularly your funding costs and your cost of borrowing rise, how are you going to handle that on the lending side to your customer? We took the approach of holding rates to customers, and in fact, we continued to reduce the average rate we charged our customers. We felt that would just instantly make us even more competitive in the marketplace, which it proved to do. That also led to an acceleration of growth because we were now on the price side of the ledger instantly more competitive. That accelerated growth only helped contribute to that operating leverage dynamic, which helped, again, more than compensate for rising funding costs. So we've obviously done some level of pricing optimization. Certain segments of borrowers have to face price increases, but the vast majority in the portfolio as a whole has continued to see average prices that we charge come down.
Interesting. And how did you, we talked about this when we were doing the planning call, and it was really interesting to hear that your customers actually maybe didn't struggle as much as one might have thought during the credit, the rate hiking cycle that we've seen. Can you talk about why that is?
Yeah, I think there's this conception that a lower credit score customer is going to struggle more during a period of economic stress, and that a better credit quality customer is going to perform better. And although it's counterintuitive, it's actually quite the inverse. There's a few reasons for that. The non-prime customer that we serve has half the level of debt to household income that the prime borrower does, and that's simply a function of less access to credit. They also only about 20% own a home. The majority, 80%, are renters, unlike the Canadian household home ownership rate, which is about 65%. So again, interest rates, fluctuations in real estate markets don't have the same adverse effect.
They're not dealing with that mortgage price.
They're not dealing with the mortgage pressure that everybody's familiar with exists in Canada. The customers also tend to have more unemployment insurance coverage to help make payments in the event of unemployment. And this is also a customer who has a very average Canadian income profile at around $60,000 individual income, widely distributed across all major industry sectors. There's no real concentration. And so they're generally able to get reemployed fairly quickly and find new income. So they just perform much more resilient during economic downturn than I think most people assume they will.
That's really interesting. The Canadian government has, this has been in the works for a few years now, but they plan to lower the maximum interest rate that can be charged, which used to be 47% on an APR basis. It's going to drop to a maximum of 35% in the new year. I know you guys have always been, you've been opposed to this change, broadly making the argument that it will cut off access to credit for some borrowers. But you've also said that most of your own maximum or your average lending rate is actually lower than that now. Can you talk about how this change will affect your business model, your company's business model, and the industry more broadly?
Yeah. So today our average rate of interest is about 29%.
Yeah.
And so with the change in the maximum allowable rate, there's a fairly minimal impact on our business. Only a minor subset of our loans are offered currently at rates above 35. So as we weigh that into the portfolio, make other pricing adjustments, the portfolio runs off. It generally is fairly limited impact on our business. We still chose to advocate for the customer and for the industry and try to encourage regulators to rethink changing and stepping down that maximal allowable rate. Everyone knows how consumer credit works. The price of a loan is commensurate with the risk of the loan. It's no different with an insurance product. And so that means if you regulate what someone can charge, the reality is that businesses aren't going to issue loans that are not profitable to do so. And then the byproduct of that is a bunch of customers that previously were able to qualify for traditional financial products from licensed regulated organizations get pushed out of that market, and they have to turn to more expensive products like payday loans. They have to turn to illegal lending sources. It has a very significant series of unintended consequences. It's nice to think that simply lowering the maximum allowable rate will mean everybody will still get a loan at a cheaper price, but just practically and mechanically, that's not how the business model works. So we were very vocal about this was not going to be good for Canadians at large. There would be several million consumers who will lose that access, even though for us and our business, we generally serve a better credit quality customer than those affected, and the average rate's much lower, so we're not expecting to experience much impact.
When these changes were first announced, your stock did take a bit of a hit as well in reaction to that. Has it just been a matter of sort of telling investors, getting that story across to investors?
Yeah, it's mostly been just education, walking people through the composition of our portfolio, walking them through the proportion of borrowers that we're no longer going to transact with, explaining how the credit risk and pricing relationship works, showcasing that there's a runoff portfolio that takes some time to wind down as the new product ramps up. So mostly an education factor. I think the other thing that's happened, though, since that regulatory announcement in 2023 is that a combination of the difficult macroeconomic environment, inflation, rate hike cycle, and this pending regulatory reform has put so much pressure on smaller scale companies that we've seen almost no new entrants. Many of the smaller subscale companies have struggled or left the market. And so we've also seen accelerated rate of growth as the demand has moved toward those select few companies that have a meaningful level of scale. So in reality, we've actually seen, for those of us that have scale, more demand and more growth. That accelerated growth, of course, helps produce future sustainable earnings for shareholders.
You guys have tapped the bond market a couple of times this year. What's the experience been like with the markets, and any thoughts on raising more in the near future?
Yeah, so we'll be ongoing issuers of bonds. Going back to the debt and capital stack, about half of our debt comes from the bond market and those unsecured notes. So as a result, we're constantly issuing somewhere between 300 and 600 million of Canadian new issuances every 12 months, effectively. The response has been great. We've last several deals have all been well oversubscribed at the level of need that we've had, so the demand has been strong. I think stepping back, looking bigger picture and longer term, as we have de-risked the business, brought down the weighted average rate we charge our customers, as our loss ratios have continued to decline, as people have seen us navigate through economic headwinds, and that the loss ratio of this business is able to stay very stable and consistent and predictable. All of that means every time we look to raise new capital, there's just a bigger number of investors and more demand to be able to take up our needs.
You've talked in the past about M&A outside of Canada. Can you talk about your thoughts on that now? I know you're obviously trying to find somebody to take over your job at the same time.
Yeah.
What are you thinking about that kind of thing right now?
Yeah, so we still see M&A has been and still see it as a big part of our growth strategy in the future. Obviously, there's a period of time right now where we're focused on a CEO transition as the priority. Inevitably, that means we want to get through that. But it doesn't change the long-term plan and strategy, which is acquisitions and potentially outside of Canada are still appealing. I think the thing we always remind people is that when your business is growing at such a robust rate on an organic basis, to make the math work on an acquisition, it's just a very high bar. It's a very high hurdle rate. So something has to be such an excellent strategic fit, excellent financial fit, that allows us to be very disciplined, very choosy and selective. And so, to date, we've not seen anything outside of Canada in particular that we've been too excited enough about and gotten to the finish line over. But as the next few years unfold and we get the CEO change settled, we'll be right back to thinking about acquisition.
Well, thank you, Jason. I know you've told your story a lot today and really appreciate you coming here and sharing it with us. Thanks very much for your time.
I appreciate it. Thanks so much. Yeah. Thanks, everyone.
Please welcome to the stage Oliver Daschle, Senior Vice President, Capital Markets of Aris Mining, Bryce Hamming, Chief Financial Officer of Taseko Mines, and Eugene Lay, Chief Financial Officer of Hudbay Minerals, for a conversation with Bloomberg's Anne Riley Moffat.
Well, thank you for joining us today. It sounds like everyone has had a busy and productive day. I hope everyone here has as well. We are talking today about mining, which is obviously a big part of the Canadian economy. Wanted to start off by talking about M&A. I mean, obviously, it has been busy in the M&A space in the last couple of years, particularly in gold. Maybe we'll start with you, Oliver. But just kind of curious, what is making M&A so attractive right now? And in terms of a buy or build model, what do you think makes more sense?
Thank you. And first of all, thank you very much for having me. Right, great to be here. In terms of buy and build, that's been the strategy that our CEO, Neil Woodyer, has pursued all his career long, right? Neil has been the founder and CEO of Endeavour Mining, which today is I think, $6 billion market cap company. Then afterwards, he founded Layer Gold, and now Aris Mining is his third stint. And in each of those cases, it was buy and build, right? And I think those case studies illustrate how much value you can create by pursuing this strategy. And, for us right now, we're very much focused on the build part of the equation, considering we have an organic path towards 500,000 ounces in the second half of 2026. But generally speaking, I think M&A has an important role to play because scale matters, right? Investors care about size, operational risk diversification, country risk diversification. You can achieve those things through scale, right? And therefore through M&A. And so I think it has an important role to play at the right point in time.
Yeah, thank you. And Bryce, maybe I'll ask you a bit about M&A too. Certainly we've seen a lot of the activity with the bigger names. Do you expect it will start to trickle down to your mid-cap and junior miners, and what will it take to start seeing activity in that space?
Yeah, I think Taseko's a copper producer. We have a single asset. Ourselves, we're pretty focused on advancing our own pipeline of projects. We have the Florence Copper Project, which is under construction. That's going to become our second operating mine next year. I think, as I look at it from our perspective, I definitely think there's the opportunity for it to trickle down. It's not something we're focused on. I think the juniors are still struggling to raise capital. I think there's opportunities to get positions, toeholds in some of the juniors as they need equity capital. That's something that we've done in the past. We've invested in a couple of our projects, taken 10, 20%, and then eventually taken on those assets once they get to a certain stage. So I definitely think you're going to see it trickle down in various forms. as far as Taseko is concerned, we're very focused on what we've got ahead of us with our own portfolio.
Absolutely. Go ahead, Eugene.
Thanks for the question. I think from my point of view, in base metals, really the battle for ownership and control of critical minerals and copper in particular is really just heating up. And a decade ago, you saw China ubering up copper mines. And just recently, the last couple of years, you've seen the majors start to get licensed, investment license from investors to make acquisitions. You've seen the likes of BHP, Rio Tinto, Glencore, and many others start to acquire mines, as it's still cheaper to buy than to build. And I think until you see that the incentive prices, until we see that the equity prices of copper companies rise above the incentive price, then I think M&A is going to continue to happen, and I expect that activity will certainly be strong and continue.
Yeah, well, I'll stick with you, Eugene. Certainly when you talk about mining, metals, there's a certain ESG investor who thinks that it sounds industrial, it sounds dirty, though of course there are many people who don't like the word ESG investors anymore either, so I know the tide is always shifting. But can you talk a little bit about that space, about industrial and critical minerals and the future end use markets for them, and how you really square that with the physicality of pulling it out of the ground?
I think the new lexicon of critical minerals has given an opportunity for the broader market to appreciate that these metals are essential for the energy transition, they're essential for decarbonization, and today they're essential for data centers and AI. So whether you're left or you're right, I think there's a recognition that these minerals are needed, and where do you get them? And so, from my point of view, the companies you want to operate these type of mines are the North American-based mines or miners who have the highest environmental and social standards. And those you're going to need these metals, and you want companies who have adhered to these high social and environmental standards to be operating them and to be operating globally. So I think it's given a new opportunity for people to understand mining beyond the physical aspects that we're probably more focused on in the past negatively.
Right. Now, Bryce, given all the new end-use demand for copper with the electric cars and the electrification of, everything, do you think there is going to be enough copper long-term to meet that demand?
I don't think so, no. Not from some of the projections I've seen from some of the industry coverage that we see out there. They're talking about doubling the copper demand over the next, some people say 10 years if you look at S&P Global, others saying by 2050. That's an order of magnitude the industry's never really supplied before. Projects are getting lower grade. They're expensive to build, their scale. So there's definitely going to be supply challenges to meet that need. And how demand reacts to that is sort of yet to be seen. But there's definitely a sentiment here with copper that we're heading into a period here of structural supply deficits. So.
Yeah. Now, obviously, the dynamics in the gold market are a bit different, Oliver, but maybe you can talk to me about, in our conversations, you mentioned a unique program you have on the ground, I believe in Colombia, where you really address some of these ESG issues in a very localized way. Will you tell us just a little bit more about that?
Yeah, sure. Colombia is in certain ways unique in the sense that there has been artisanal mining for centuries, right? And so there's a deep legacy of mining within the communities where we operate. And when we look at this, we think to ourselves, we got to find a way to coexist and collaborate and find a business model and an operating structure that ensures that we deliver a net benefit to the communities that we're operating in, right? And we have calibrated a business model by which we partner with contract mining partners that are kind of like former artisanal miners that have chosen to come out of the shadow economy into the real economy. And our partnership with them is good business for us. It enhances profit and cash generation for us, but it also results in them being financially better off. And now they're in the real economy. They qualify for social benefits, they can open bank accounts and so on. And that business model also helps the government in the sense that it formalizes a vast artisanal mining sector that maybe hasn't always paid taxes, right? And from an environmental perspective, to Eugene's point, you want to do processing or kind of in general the extraction of minerals in a responsible way. And you can do it the right way, or you can do it the unsafe and polluting way, right? And by us taking care of the processing, there's a lot of environmental damage mitigation, right? And so this business model, in a way, uplifts the communities, creates kind of like a scenario where all four key stakeholders are better off. And to me, that is how you want to calibrate like ESG, right? Something that's not a box-ticking exercise, but something where it is really ingrained in kind of like how the corporation operates, right? To me, that is long-term sustainable, and that is what protects the social license to operate. And unfortunately, the mining industry is littered with examples of companies that have lost their social license to operate because they didn't demonstrate that net benefit to the communities where they're operating in, right? So to me, that's really important.
Thank you. I remember just thinking that was so interesting, a very win-win situation. Just reminding everyone that we can take questions from the audience. I believe it's an app. Feel free to submit questions, but I will continue for now. Eugene, would you say that mining companies are undervalued for what they offer?
I don't think you'll have an executive on a stage to say that they're overvalued, but I think if you look at the cash flows and the cyclicality of this business and the long investment cycles it takes to create, a ton of copper or an ounce of gold, and the industrial uses for these, particularly by the tech companies, and you compare, I think, the valuations of some of the tech companies versus the mining sector as a whole, it pales in comparison. So I think there's always an opportunity for us to demonstrate that these are sustainable returns, and I think that in this cycle that we've seen, many of the companies have generated substantial shareholder value and returns, and I think it's one of the reasons the M&A has been a bit muted. They're a bit afraid to make a big bold step, and so I think as we've earned the right for higher valuations, you'll see that be rewarded with higher share prices and higher returns for shareholders.
Sure. I mean, this is a conference on Canadian finance, so I will ask a bit about finance. So, Bryce, obviously there have been some changes, whether state-owned foreign entities can invest in Canadian companies. In your experience, because of that or other reasons, has financing tightened up in this sector?
No, I think we're in a very good position for particularly, established miners to raise capital. Taseko has been very active over the last couple of years, getting ourselves in a position to build our second mine. We found diverse pools of capital. We've gone to the bank markets. We've gone to the royalty and stream sector, which is quite large and has had quite a niche in this space. But we've also had a lot of success in the capital markets. I think the capital markets have been very constructive. We've done two series of refinances of our notes and tapped that market to help advance our projects. And then, of course, the capital markets, we've had great returns over the last few years with sort of this realization of mining and its importance and its need for the energy transition. And I think that access to capital is going to continue. It's still, in the junior space, I think there's still challenges, but I think for established miners looking to grow and build mines, I think it's available in a significant way. I think from a foreign perspective, we've seen, I think Canada still has its challenges to attract foreign investment. We have to differentiate ourselves in Canada. We have a number of properties in BC, and we need to remain competitive with the global landscape, and that requires, government commitment to achieve permitting goals and objectives, but it also, to the points of responsible mineral development, I think we've got to continue to have rigorous environmental standards, and I think that'll continue to attract capital, but we've got a lot of work to do in Canada in particular.
Mm-hmm. Eugene?
To your point, Bryce, I think that the juniors and the mid-caps have been able to attract some capital along with the seniors, but a lot of the exploration companies have not been able to, and I think that's twofold. One, obviously, we haven't seen the level of M&A where companies are building mines sustainably, and so they haven't had to replenish the pipeline with new projects, and so there haven't been the takeouts of these exploration companies and juniors that usually spur on the stock interest. The other thing is, I think, the big move from active fund management to passive fund management, and so getting away from stock pickers, I think it's been really tough for the junior market because it's hard for a passive manager to differentiate what's good and bad. And you're looking at market caps, you're looking at scale, as Oliver mentioned, versus something that's like a geological a discovery that really spurs on that market. So I think that market continues to lag, and it's going to take some time for the M&A cycle to complete before financing cycles down to the junior and exploration companies.
Right. Now, Alva, I'll ask, when a company has these kinds of capital constraints, not your company, but industry-wide, where is the best place to spend their money right now if they have limited access?
I'm not sure there's a one-size-fits-all answer to that, right? I mean, ultimately, it comes down to what is the best risk-reward proposition in your respective portfolio, and for each and every company, that's different. For us, it's very simple, investing in our 2 operating assets that we're doubling in size, right? There's no one-size-fits-all, and ultimately, you need to look at what delivers the best risk-adjusted returns to the shareholders and the stakeholders more broadly.
Mm-hmm. And I'll stick with you. When you and I were talking in advance, we were discussing the idea of whether or not Canadian pension funds are underinvested in this specific sector. Just what are your thoughts on that?
I want to be a little bit careful, considering I'm not a Canadian citizen. I'm a German who has lived here in the US for the last 13 years. And I'm not sure I want to wade into a debate over how Canadian pension dollars should get invested, right? But Frank Giustra and Pierre Lassonde, I think, have laid out a pretty compelling case for it. So I would just kind of refer to that, what they have said, right? And I mean, my 2 fellow panelists here are actually Canadian, and you have assets in Canada. So maybe I hand that over to you.
You might not want to touch that, but feel free.
Yeah, look, I think there's always opportunity. Look, I think there used to be a lot more institutional following in mining space in general in Canada, and I think that's, these specialist funds have slowly disappeared. And I think, like to Eugene's point, like we're seeing a lot more electronic trading and a lot of quant funds and others enter the space, which has created good volume, good access to capital, but has probably changed the industry and moved it away from some of those, what we would typically expect to be on a shareholder register. So I think there's definitely room for them to swing back, especially given the need for capital, given for them to see these stable and robust outlook returns that the mining industry here is promising over the next decade.
Absolutely. I see we just had a question come in. Thank you. I'll read it out loud. Do you all see it? No.
Oliver's question.
Do you think increased geopolitical tension and ballooning public debt in developed economies would boost the demand for gold and precious metals over the medium term? So Oliver, we will start with you, but then Eugene, I know Hudbay gets like 30% of its revenues from gold, so feel free to weigh in too afterwards.
Short answer, yes. Look, gold is perceived as a safe haven asset, and unfortunately we have rising geopolitical tensions, and wars that are currently ongoing seem to get more intense by the day. So that clearly kind of bolsters the case for safe haven assets. Importantly, we are at record high gold prices against a backdrop of still elevated rates, right? And I think that is a remarkable statement in and of itself. Now we have an easing cycle, not just here in the US, but pretty much across every Western economy, which, if history is any guide, should be a meaningful tailwind for gold prices. And then, look, I think a day or two ago, the IMF came out with a report that says more than $1 trillion are going to be owed by governments around the world, which is, I think, around 100% of global GDP, if I remember correctly. Doesn't seem particularly sustainable to me. And I mean, the budget office here in this country has warned for many years that the path is unsustainable, right? When we think back a couple of years ago, Liz Truss announced her mini budget, and it evoked a pretty meaningful response from capital markets. So yeah, how long that is going to still be supported by capital markets, I don't know. But I get the sense that gold starts to look more appealing to investors who are concerned about that risk.
Yeah. And Eugene, I won't make you call a top, but what drivers are you watching in the gold market right now?
Yeah, I won't call it top. It's still going. At Hudbay, we're a copper company where copper is our primary metal, and copper is the barometer of general economic activity. And given the positive economic outlook for the world in the longer term, I think that is a nice industrial metal. Gold's usually, as Oliver mentioned, a barometer of political instability, and so usually for us it's a counter-cyclical hedge. One goes up, the other one goes down. We're in this really unique time in the world where they're both going up for different reasons, and so we're enjoying the fruits of what we planted in both cases. So I'm not calling the top of either. I think there's certainly, Hudbay does believe in the long-term supply and demand fundamentals for copper. They're really sound, they're robust, and it's founded not only in the demand outlook, but in particular the very shallow supply pipeline that we see. In terms of gold, I think that the continuing geopolitical uncertainty and high debt that all of our countries are operating in provide a positive backdrop for that. So looking forward to continued strong prices and strong returns for our shareholders.
Thank you. I will say the common denominator today is obviously Canada, but at least two of these companies are operating or building projects in the U.S. So maybe, Bryce, you could talk to me just a little bit about how you're finding the process of permitting, regulations, red tape, in the U.S. with your Florence project versus what you've experienced in Canada before.
Yeah, like we are, coming out of a pretty long permitting process here in the U.S. We were successful. We got the commercial scale underground injection control permit from the EPA last year. So we've started construction. I would say that's a very rigorous program. We did it in 2 stages. It took a long time. When you factor in our previous owner started it in 2010, it took us 13, 14 years. I think people are going to judge that to be relatively quick when it comes to the U.S. But I do think it is, a desirable jurisdiction. It's an area that we're continuing to focus on is U.S. opportunities. I think the U.S. in certain cases are open to mining. We are very proud to be advancing a new source of copper for the U.S. market. The U.S. market needs for cathode, they're heavily reliant on imports, and that's not changing here with Chinese dominance of the metal industry and especially copper. So, I think it's I think Canada can look to it because I think there's still examples where the U.S. is able to advance projects through and get permits done, and still we have other projects in Canada that are still struggling to get to that end game of construction ready.
Right. And Eugene, have you found that HUD-based projects in the U.S. are you have to approach them somewhat differently than your Latin American or Canadian projects?
I think governments across the world today, have to balance the interests of too many constituencies and special interests, and so it's difficult for them to satisfy everyone. And we're only seeing now, particularly in the U.S. and Canada, and the need for support for these critical minerals to ensure that we have the supply for our North American supply chain. And so I think that's changing. We have gone through again a rigorous process of permitting, getting the social license to operate, and all of our jurisdictions, and we're finally seeing leadership from federal governments in Canada and the U.S. and to understand that having North American supply of these critical minerals is really essential for sustainable economic wealth creation across the country, and balancing those special interest constituencies with the kind of long-term strategic mandates for these governments. I think it's been tough, but I think they're starting to see light.
Yeah. Now this is blinking at me, so I'm going to do a quick lightning round. round. I'll ask all three of you, what is keeping you up at night in this sector? And then secondly, if you are back on the stage a year from now, which we hope you are, what do you think will be the biggest thing that we are all thinking about and talking about? I didn't warn you about this one. Eugene, I'm going to put you on the spot and make you go first.
What keeps me up at night? Just everything in our industry is predicated on social license and alignment with our community. So ensuring that we have the broad support to operate and license to operate across all of our operations with the highest social and environmental standards and generating economic wealth for all of our communities is what's a primary concern, and that gives us the incentive to come to work every day. In terms of a year from now, I would expect, as I said, I think we certainly expect to see higher copper prices and probably similar gold prices. I don't know about higher gold prices, but similar gold prices in my view.
Thank you so much. Bryce?
Yeah, quickly, I'll just say, look, it's excitement. I think this is an exciting time for mining. Our business we're a very transformational time, getting our second mine up and running and building that out for production next year. And it's just this access to capital. I think we're seeing support across the capital structure. So it's an excitement that keeps me up at the moment.
Good answer. Oliver?
I sleep very well. Nothing keeps me up at night. But, I guess, we're laser focused. Not I guess, we are laser focused on delivering the 2 expansion projects that we're working on. That is front and center for us. In terms of kind of like surprises for next year or what my hopes would be, I would hope that we see the general investor come back to the sector. Right? I mean, right now the investment universe is dominated by, mining specialists, and I do think the industry is way too critical in terms of what it enables, right? That it can get, it just can't. I think the global economy cannot afford to overlook and underfund the industry for much longer, right? So I have a hope that generous investors pay more attention to it, and I personally have started to seeing some green shoots in that sense.
Sounds great. Well, thank you for joining us, and thank you to our panelists.
Thank you.
That's it.
Please welcome to the stage Aida Chipola, Chief Financial Officer at Ontario Power Generation, Arthur Kasprek, Vice President and Treasurer of Hydro One, and David Krent, Managing Partner and Chief Financial Officer of Infrastructure at Brookfield Asset Management, for a conversation with Bloomberg's Noreen Malik.
Good afternoon. We're saving the best for last, and we've got a wonderful panel. Aida Chipola, she's Chief Financial Officer at Ontario Power Generation. Arthur Kasprek, Treasurer at Hydro One, and David Krent, Chief Financial Officer of Infrastructure at Brookfield Asset Management. To start off, just give us a brief background, a snapshot of where you're coming from in your company.
Yeah, no, for sure. So at Ontario Power Generation, or I'll refer to it as OPG, we are the largest power generator in the province of Ontario in Canada, and but we are one of the most diverse power generators in North America. And so our fleet of assets include 2 nuclear power plants, our Darlington power plant as well as our Pickering power plant. We have 66 hydroelectric facilities. We also have a solar facility and thermal plants. And we also have a subsidiary called Datura Power, where we have 4 natural gas turbine generators, or our natural gas fleet. We're also doing battery storage, 250 megawatts. We have a hydrogen pilot project where we're doing green hydrogen through Niagara Falls, our hydro station. And then we also have a subsidiary in the United States. We're in 19 states throughout the U.S. where we have 85 hydroelectric operations, plants, including now some community solar here in the U.S. And so really sort of diversified and looking to continue to grow as we go through the energy transition. So thank you very much for having us here today.
Arthur?
Right. Well, first of all, thank you for having us here today, and fitting that I actually follow after Aida, because we're utility operating in the province of Ontario, transmission and distribution utility operating in the province of Ontario. We do not have any generation here. So as OPG generates, we transmit the electricity. We only operate in Ontario. We're 99% regulated. We are publicly traded on the TSX, but we're still 47% owned by the province of Ontario. We have an A-rated balance sheet as well.
David?
Great. Thank you, Noreen. So Brookfield Infrastructure is probably one of the largest pure-play infrastructure public companies in the market today. We own assets across 4 key sectors: utilities, very similar to the types of assets my counterparts have mentioned, but also transportation assets, midstream, so typical natural gas transmission, and more increasingly digital or data infrastructure, which is a huge growing trend in our business.
Got it. And I'll just take a moment to say I encourage you to send questions. We can see it on the screen here, but no pressure. So I guess, 2024 has been about power demand growth. And so what excites you the most about it, or other infrastructure? Like, what's at the top of your list? And I have to ask, where does AI fit in there? It's like somewhere on that list.
Oh.
Ida.
Yeah. Oh, of course it is. So I think what excites us the most is this energy transition. For many of us, the energy transition is about an element of, yes, getting to net zero, yes, the energy stability and reliability that we need across all of North America, but the world for that matter, and energy security, but it's also about really having electrification completely put together. And so when you think about all of that, what you're seeing for the first time is real demand come in. For so long, we've been looking at conservation and elements of that through our sector in Ontario. And what we're now seeing is true growth coming in. We had projections in the province of Ontario of 2% real growth earlier this year. And just today, our independent electricity system operator released out their annual planning report for what they're now seeing, and it is looking as it's 4.6% increased in growth over the next decade. To put that into perspective, that's a 4% increase in the next 10 years. What that's talking about, and really earmarked here, is data centers. And so they're projecting 16 data centers, 1.6 gigawatts in that next decade. So 13% of that real growth is going to come from data centers in the next decade. And so the trend lines, and they had issued out a report back in December of 2022 called the Pathways to Decarbonization, and it played out a world of believing in net zero, no natural gas in 2050, and a world where you had electrification. And at that point, we're talking about a build out in our province alone in Ontario of over $400 billion for the power generation and transmission, and the consideration of needing to double the grid. And so that, one could say 2 years ago, was a vision around what could be and where you're going to overbuild that. The growth is really here, and their model that came out today says that the near to medium term is underestimated in that long-term model. So I think it is here, and I think it's serious, and we really need to think about the reliability and how are we going to build that out. So things like small modular reactors, large nuclear, refurbishments of nuclear, increased hydro in the north of Ontario, and renewables, wind and solar, all of it. We're going to need all the tools in the toolbox.
I would say ditto to that, and it's all my thunder. But yes, we're seeing a real growth happening, and as the transmitter in Ontario, we're seeing firsthand. We actually have 9 transmission lines that have been commissioned or we've been asked to build, separate to our regular transmission maintenance and build-out, transmission lines just to actually support that growth. And to give you some maybe concrete examples, in southwestern Ontario alone, we're building 5 different transmission lines, and that's to support growth. One, for example, in the EV supply chain. So we have the likes of Volkswagen coming in and announcing a plant that's going to come in the town of St. Thomas. We got Stellantis, LG building plant in Windsor. Honda just announced recently a new infrastructure investment into their EV manufacturing. So a lot of growth there. On top of there's a lot of growth around agriculture. So to put some numbers around it, just in southwestern Ontario, right now the demand is expected to grow from about 500 megawatts right now to 2.1 gigawatts, almost 4 times the expansion. And plus then we have growth. We're seeing growth in the north as well with the development in Ontario. We have the Ring of Fire. That's an area that's very rich in minerals. So there's obviously going to demand around developing that area and getting transmission put out to support that. We have initiatives coming on board from electrification for some of our steel makers, both Dofasco and Algoma announcing electrification initiatives. So I echo all of that, and it's real, and we're seeing it as well.
Yeah, look, and I won't be repetitive. I'll try to, at least, that's one perspective, I think, and it's extremely prevalent in all the markets. I think the US is probably the leading indicator based on where these hyperscale customers are based. They've invested heavily in the United States first. And now you're going to start to see it ripple out into Canada. We have businesses in Australia, South America, and India where we're building data centers for these companies. And the opportunity set's massive. I think Google came out today with a 5 gigawatt plan for nuclear to power it. I'd say that's longer term. This is 2030, 2039, their targets are. I think the one element I would add is that we're very firm believers that, and from talking to our customers, is they need capacity tomorrow. So lead time is extremely valuable. And for our customers, having access to power today is what's really important. Yes, they need these projects 5 years from now, but they also need demand tomorrow. And the only way to do that today is with natural gas. And I think you're starting to see a renewed optimism around natural gas, especially in the United States and also in Canada, just given our mineral-rich economies, that I think that's a huge tailwind in the near term for businesses that have a bit of a diversified mix like ourselves, like OPG.
Go ahead.
Yeah, I was just going to jump in on that, and I think there was an announcement today as well with Amazon around X Energy, so their partnership around that and an investment in looking at Energy Northwest and building out the small modular reactors, a minimum of 4 up to 12, because of that need of the data centers. So you see that with Amazon earlier this week. You mentioned, David, about Google. There was also previously Microsoft with Constellation and 3 Mile Island. And so you're looking at this need for the actual data centers, the AI, and they need that continuous 24/7, 365 days continuous service. And so the question is how do we get there? Because I think it is real. You're absolutely right. It's United States that's sort of driving this, and then the peripheral around jurisdictions that can help. And so it's here and it's now. And there's that element about natural gas as well in that amount of being able to peak. And I think we're seeing that in sort of today's announcement in the province of Ontario. We're going to need to be able to have the power. You need the lights on. Like, it's an essential service.
Yep.
And we know that we need that for manufacturing, for businesses, for homes, and for us in our day-to-day lives. And so it comes, how are you going to do that? And so it becomes an important part of that while we build out the green electrification of the future through renewables, nuclear, and the various diversity.
Yeah, because don't forget, as much as these SMRs and nuclear is the base load, it needs backup. It can't only rely on that, because if it trips and their data center's down for a period of time, that's detrimental to their business. So we're seeing the utilities come to us say, well, we need gas as the backup. Can you connect a pipeline into our facility so we have that access in case there's maintenance requirements on the nuke? There's considerations for reliability that are extremely valuable that I think have been proven the last 3 or 4 years that I think people overlooked when the transition was maybe accelerating faster than people were ready for. And I think you're seeing the system and the grid start to catch up to that.
Can you even build gas right now? Like, where can you build it? Like, we've seen a lot of backlash in the US for like getting permitting issues or pipeline costs that got too high, that projects got canceled. And of course there's this big ask to build a lot of gas generation, and there's like a 4+ year wait on combined cycle turbines right now. What can get done practically?
It's a nuanced question, because I think it depends on the state and the regulation and the political environment of where you're operating. I think that's the reality of natural gas, is it is more political. And same with nuclear. It's going to have the same politics around it. So I think it's having the long-term view that these will be needed elements to the energy grid that I think hopefully people can work together to come to the right holistic solutions that includes all of it, rather than picking winners and losers and subsidizing those types of industries. I think we'll naturally need a bit of all of it, and finding the right permitting regulatory framework to get new projects started will be key.
Yeah, and maybe what I can add to that is, so if we look at the province of Ontario, we've been doing refurbishments at our Darlington new nuclear power plant, $12.8 billion project, 4 units, on time, ahead of schedule. And then at the same time, Bruce Power is also doing their refurbishment as well. So we have been off having nuclear. We have half of our Darlington plant is currently in refurbishment. We'll bring another unit back by the end of the year. But we need natural gas. And so what would have been 10 to 12% of the grid being on natural gas for peaking in those summer months when you really needed to, it's hit up to 25% just in base generation, because we need it as we do and we build those.
And if you don't have it, think of the prices.
Exactly. Now, The one element with that, though, I think also comes in, and we will be building another natural gas plant. And so where it's being done, we've now entered into another agreement for 411 megawatts to build out at one of our current gas to be able to have the power during these periods of refurbishments. As we build out our hydroelectric, as we do refurbishments, we need to have that stability in there in that next decade when we'll have all the green power. So I think to your point, it is jurisdictional.
Yeah.
It is going to be, I mean, we're very blessed that we're in a province that is a big nuclear supporter in certain areas. We have a big support around that. And I think it's about being able to get to that end state by keeping the lights on.
Arthur, one of the big stumbling blocks for the transition or even getting new power on is the interconnection queue. How do you even manage that? Because you're responsible for your territory to bring online new projects. What's your queue look like, and are you doing anything different?
We have, like I said, we're building out 9 transmission lines right now, priority transmission lines, soon to be 10 potentially. That might be added to the mix, and potentially others in the future as well. So look, transmission does take time to build out. There is certainly obviously permitting and so forth that needs to be considered into that. The good news is as we think about building out transmission, we are looking at ways to shorten. I'll give you an example. Our most recent line that we're about to put into service in the southwest, the Chatham by Lakeshore line, we're actually coming in about a year ahead of budget on that line. And that's a lot of it was actually due to simple things like, for example, streamlining permitting, right? Having the federal and the provincial permitting instead of having sequentially happening concurrently. So things like that need to be kind of thought through, because it does take time to build transmission. It certainly does.
And just to follow up on that, you mentioned permitting. I mean, there's been a lot of community backlash for basically everything. It used to be oil pipelines, gas pipelines, and now it's like plants and even data centers. How have you built a coalition to support your projects?
Yeah, so one of the things that Hydro One is actually a pioneer in is actually Indigenous participation. So one of the things Hydro One is offered is any new transmission line, the transmission component of that line that's in excess of $100 million, we're offering 50% Indigenous participation. So a lot of these transmission facilities are being built across traditional Indigenous lands. So that itself is a win-win partnership, right? It helps to some extent with some permitting and so forth, but also allows for a genuine benefit to the communities that those lines cross, and allows those communities to participate in the ownership of those lines. So it's a win-win model for us.
Yeah. And if I could just jump in, I think, speaking alongside Arthur at Ontario Power Generation, we recognize the importance of our Indigenous communities, how we partner, and how we look at being partners together. At OPG, we announced $1 billion over the next decade to recognize how we support the economic benefits of Indigenous communities. And so it is about providing them opportunities to be within the supply chain process, getting jobs within those communities. How do they procure? How do they come in? How do we employ to have representation at OPG of employees? And we also recognize equity participation is going to be important on our projects and anything that we do from a consideration and a greenfield. But it's about understanding what those communities need, and so in understanding how we partner together, that we have that jointly together, listening, being educated, and reflecting on what that means. And so we spend time in the communities, our Indigenous relations team. It's really important that you hear, you listen, and you learn, and I think that's been very important for us as an organization.
And David, you mentioned that the backlash that gas has seen will likely translate to nuclear. What are some of the lessons learned, and are you doing anything proactive? Because you're also in nuclear as well.
We're not yet. Our sister company, Brookfield Renewable, owns a piece of Westinghouse. So that's our direct exposure there through the Brookfield universe. But I'd say the natural gas, in terms of the question around nuclear itself, look, I think it comes down to financing right now. So it helps when you're a government entity to have that kind of capital available and that long-term vision for your constituents. As a public company, it is a lot. I think the question it comes down to is financing, and who bears the risk around new development. So we don't have answers, and we don't have a way of adapting to that yet, but that's where I think you'll see evolutions now. Now that you're seeing a lot more commercial acceptance for these types of projects, I think you'll see a lot more first movers in terms of leading financing, capital structuring, risk sharing arrangements that can help get these projects in the ground and started. But I think that's the biggest hurdle right now, is how you manage that risk.
consumers are facing rising costs and likely going to go up as we see all these transmission projects and generation projects get completed. And there's a lot of concern that the hyperscalers coming in that will significantly increase demand very quickly are going to just add to that burden. What is the role of the hyperscaler in this energy transition, or do they have to take a different, take more risk? What's changing, the relationship?
I'll start and feel free to elaborate on, but I think you are seeing some new frameworks come to market that you wouldn't have seen in the past when you had a traditional industrial user come onto the grid, because the hyperscalers have competing demands, I would say, that are mutually exclusive at the time being. That is, growing their critical revenue generating models and technology, which is the forefront of their business, and also committing to net zero, which they've done on accelerated timelines. I think some of them are as soon as 2026, believe it or not, which is fantastic for them. But in the current energy landscape, it's almost impossible. So I think you're seeing them do two things. One, come up with nuclear as part of that path. They're doing large arrangements with renewable power companies like Brookfield on that front. And you're seeing them jointly approach utilities and constituents and talk about, ways in which they can get access to power, but not have the tariff go necessarily straight to the user. So they may have to subsidize the power in that market. And that, again, is going to be state by state, regulated by regulator, those discussions. But you're seeing that framework come together where they're going to be more of a partnership in terms of how they get access to the power, but also not take up critical load from local universities, hospitals, residents that need the power as well.
Maybe just to add on to that, I think the way that we look to finance nuclear is going to have to be different than what we've done in the past. And so much of this is going to have to be how we consider elements around that. And so one of the big things for us at Ontario Power Generation was about talking about, and in response to, from a federal government point of view, the IRA here in the United States. And so in Canada, investment tax credits now originally were looking to be invested specifically just for small modular reactors. It has been expanded into scope into small modular reactors, new nuclear, refurbishments, and on the renewable side, energy, pump storage, battery storage, all of the things, effectively everything that OPG is working on, investment tax credits of 15% are going to be eligible. And so you take that off of the cost of the cost of the actual infrastructure build out, and that reduces electricity rates, so it goes back down to the customers, and that's a direct commitment that we've made, and through the legislation that would go back to customers. It's about how do we do this from a financing point of view. On our small modular reactor that we're building out at the Darlington new nuclear site for 300 megawatt firm clean or base load generation, we had just shy of $1 billion from the Canada Infrastructure Bank low cost financing. And so we have to think about these things different. We have to entice private capital. We have to think about ways, our equity participations with Indigenous communities. So we have to think outside the box. There's federal and provincial agencies that are looking to provide opportunities for first of a kind technologies and advancement. And so we're looking at all of those things. We recognize affordability is critical right now and very important. And we have to be a prudent operator. At the end of the day, we're 100% owned by the province of Ontario. We have to always remember ratepayers. That is the number one person that we represent. And so cost of that and low cost financing has to be a big part of that. And so it is something we deal with every single day as we think about the regulatory regimes that we need to modify and change. And there's various illustrative examples. Virginia, their governor announced ways to think about bringing forward some advancement of cash flows. Also in the UK around Sidewell C, the way in which the government's supporting that. So this needs to be a different inflection point than we've been in the past with how much capital needs to be deployed in the period to get to where we need to.
Historically, energy build-out has happened in silos, different regulators for different pieces of the business, oil, gas versus power. And Ida, you mentioned before this panel to me that you have to think about the whole energy wallet and the shift happening. How do you have those conversations, or what do those conversations look like so that you can get your projects, get backing for them and get ratepayer approval when more of it's shifting towards that bill, utility bill?
Yeah, no, and I'm happy to start, and feel free to jump in. So in our mind, it's the energy wallet. So I think if you believe 2050 and you believe that there's an element of natural gas reducing, so some will believe that it gets eliminated, some jurisdictions will say that's 2035, 2040, 2050. You pick your period. We believe we need to decarbonize. I think we all recognize that. So once you get off coal, which we did a decade ago, the ability is to get to reducing down natural gas. And so with that, your natural gas costs should come down. If you believe in electrification and EVs, your gasoline costs are going to come down. And so you need to think about it as a total energy wallet. So as those come down, your electricity bill will go up. But you need to think about it as the net wallet over a period of time. And we need regulators to help us smooth out those costs so it is not all hit at one period of time for the actual consumers as we take that on. And I think that's where it's been conversations we haven't had in a very long time considerations. And so it's different. So I think, I think it's encouraging conversations like today where we can talk about the energy wallet and think about it holistically versus just each of us in a siloed view.
I agree with that. I mean, right now, electricity is only about 20% of the consumption versus other energy sources. So as you shift away from that total wallet, share of wallet would be an important conversation to have. And as the regulator, the government, all constituents need to be pulling on the oars at the same time to really get over this. Because there is going to be, I think, a period where it is going to cost more, right? It's going to be kind of like that inverse U, right? But eventually it should come down and actually probably should be cheaper as we do get over that inflection point.
Yeah. Look, and we can learn a lot from Europe. Like they are ahead of us. And in terms of energy transition, you have the UK with a much more aggressive net zero target. France, Germany had decommissioned sites that, and they saw what happened to energy costs in the last 3 years as well, right? So we can learn how they're doing it. Right now we're doing conversions of gas boilers in Germany and France and the UK to heat pumps. And yes, it is a capital outlay up front, but over time, their energy bill is going to be much less reliant on commodity prices, which is really what gets people. And B is it's going to be predictable electric baseload that they'll be pulling on. So I think that we can learn from them too.
And then super rapid fire. This is the last question of the day. If there's so many challenges, if there's one thing you could change, if you had a magic wand, what would it be? David?
Oh, start with me.
Yeah.
Look, I think stability, we're long-term investors. We're investing in these assets for 10, 20, 30 years. No different than our counterparts. You need stable, long-term focused regulators, constituents that understand that so that they can respect capital and ultimately everyone can participate in this massive investment boom.
Yeah. I would say maybe on the theme we just talked about, and maybe not a change because we have a very supportive regulator right now, but I would say even more of that. More support from the regulator, more kind of alignment with government to be able to get us through the energy transition.
Yeah, and so I think with stability and the regulation, I think for me, what I would add to that is long-term planning. I think this cannot be a near-term view or focus. We have to think long-term, and when we can think long-term, we can plan correctly. These are long lead initiatives that you need to do for clean. It's nuclear, it's hydro, it's wind, it's solar, it's all of these things in the procurement cycle that you talked about. So we need to think long, we need to plan right, and not rush and make irrational decisions sometimes that you do in the short term. And so this is the time we need to plan correctly.
And with that, thank you so much for your insight. Appreciate it.
Thank you.
Please welcome to the stage our hosts, Bloomberg's Derek DeCluett and Caroline Gage.
Well, that's it for today's conference for our 12th year. Thank you all again for joining us at the Bloomberg Canadian Finance Conference, and we hope you enjoyed all the speakers and panelists.
Thank you again to all of our speakers for a wonderful program, and thank you to our sponsor, National Bank of Canada Financial Markets, for making this event possible.
If you would like more information on our sponsor, please visit the Resources tab on the event website, which is bloomberglive.com. And please don't forget to sign up for our Bay Street Edition newsletter, which you can find at bloomberg.com/newsletters.
And most of all, thank you for being a great audience. To watch any part of this event, you can return to bloomberglive.com and see it on demand. So thank you and have a great evening.
Our love is alive.